South Africa is not an outlier when it comes to inflation. Inflation is worse in many other parts of the world than in South Africa. But I think what happens with inflation, trying to tame inflation, has severe consequences for South Africa. I said to many people, as someone who's, I think, been on the Monetary Policy Committee for 12 years, for the first time I worry more about US inflation numbers than I do about South African inflation numbers, because the impact of US monetary tightening on South Africa is something that we cannot ignore. The other important thing is that being a small open economy, global growth has a very important impact on our own growth prospects. And that means that, that if you take 2000, when the global economy was growing at about 5%, we were growing at about 5%. The numbers are coincidence. But I think that the ability to take advantage of global growth is very important for a small open economy like South Africa. The argument today is that if global growth goes up back to 5%, it will be very hard for us to grow at that amount, because there have been a number of structural problems in the economy that makes that very hard. Okay, so this was just the point that I was making, that you can see every country has increased its rates. Actually, if you want to, if you think that we've been a bit extreme in raising rates, the Brazilians have a real interest rate of about 9%, which means that their inflation is about 4% and their repo rate is about 13%. Whereas in our case, our repo rate is 8.75, and the inflation rate is around 6.9, 6.8 the last reading. So countries have really, and Brazilians and the Latin Americans, as you know, have a history of hyperinflation in the way that we don't have. Now, we like using a term called the potential growth of the economy, a very important term. And the reason it's an important term is because the potential of the economy determines how far can you grow without having an inflation problem. So in other words, you can say that maybe the potential of a country like China or India is 6-7%. The moment they start growing above 6-7%, they have capacity constraints, and inflation picks up, and the monetary authorities have to control the economy and do that. South Africa is not the same, but it used to be a 3% economy. Pre-2008, we used to be a 3% economy. The moment the economy goes above 3%, we start seeing inflationary pressures. But now we've become a 1% economy. So in other words, the potential of this economy is very low, and the real challenge is how do you get this potential to grow. As you can see, our GDP growth is very modest. We think that the economy will grow at about 0.3% this year, but we think that in the longer run, it will pick up to 1-2%. It's very hard to make a dent in the unemployment numbers with those growth. So, one thing that's really important is, and I just throw this out, I'm not going to talk much to it, is how do you think about economic growth of an economy? Economics 101. And that is that, there's cycles. So sometimes you can have a cycle where commodity prices pick up, and we, like many other parts of countries in our continent, gain a lot. We have windfall gains from commodities. So sometimes the economy can grow for 2-3 quarters at 2-3%, and then it can stagnate again, and it's all cyclical. It's cyclical growth. But the real question is what happens in the short term, the medium term, and the long term. In the short term, we are very modest about our growth prospects. But I do think that there is a silver lining with the energy constraint, and that is that there's most of the investment we're tracking is in renewables. So you're going to see a reallocation of investment in the economy, and those kind of things I think will really be important. It's hard to see it now, but I take a very positive view about the investment that the energy problem will unleash in this economy. There's a robust private sector. You can see the extent to which solar companies are thriving. So I do think there is something coming out from this. Now, we have an energy expert. I don't want to go too much into energy. I just want to say that, a few things. It is not only energy that is constraining the potential of this economy. It is also, for example, logistics and transport. And these are low-hanging fruit. They could be fixed up very easily. It can accelerate growth a bit. But we have found that in one of the reasons why our forecast for economic growth is low for this year is the load shedding, but also many able exporters are struggling to get their goods to the harbor, their backlogs and so on. These things could be fixed up very easily and could turn the fortunes of this country quite a bit. So the thing that worried us most was the unprecedented days of load shedding that we estimate. We saw it in 2022, but that we estimate for 2023. And in our estimate, economic growth for 2023 would have been not 0.3%, but 2.3%. So this is how load shedding has weighed down on our growth. Had it not been for load shedding, in fact, we make an assumption that when we at stage 1, stage 2, actually that impact on the economy is not very significant. Firms work around it and so on. But the moment there's a non-linearity, the moment you go up to 3 and 4 and 6, its impact on growth is very binding. It's a very binding constraint. So our estimate are -2%. We think that as we deal better with load shedding, what the constraint of the economy for 2024 and 2025 is much less, but it does weigh heavily on us. Now, on the one side, the supply side of the economy is a problem. The potential has declined. On the other side, there's some positive things. Household expenditure is a bit more robust than it was. Household expenditure drives our economic growth. It's a major part of what drives our economic growth. The real challenge really comes in public fixed capital formation, or what we generally call investment. And part of the problem is that government always accounts for a large part of investment, but that has declined for many good reasons. So one of the reasons why South Africa is growing at the rate it grows is our investment as a percentage of GDP is around 14%. If you compare us to our East Asian tigers who grow at 6-7%, their investment as a percentage of GDP is around 25-30%. It's not only the level of investment, it's the efficiency of the investment. But this is the thing. We cannot conceive of having a higher growth rate above what we have currently if investment as a percentage of GDP is going to remain at the current levels. So what will it take to get investment up is the real key challenge. I'm not going to say much here. I think that the one important point is that notwithstanding the fact that the economy hasn't been doing too well, we've been pleasantly surprised at how credit extension has been increasing. Now, this is a highly unequal society. It happens in some households while some houses are bleeding. The thing that's most depressing, I think, about this economy is that we actually have not reached pre-COVID unemployment levels. As you can see in the blue graph, the unemployment level was around, the number employed in the formal economy was just above 16 million. We're just below that. And that has been the devastating impact of the COVID experience, but we've had so many other unfortunate events. What's the movie? Something of unfortunate events that really has had a very negative impact on our growth. There is the inflation. There is the inflation problem. Now, we have a 3 to 6% target. and inflation has been rather high. But this is where South Africa is not unique. There's nothing idiosyncratic about our inflation problem. It is a problem that exists in many parts of the world, and they exist for very different reasons. But the biggest culprit has been, food prices, has been oil prices. Thanks to the Ukraine-Russian war, there's not much we can do about it, but it has had an impact on the economy. We can talk more about it as we go along. We divide inflation into services, and you can see that services inflation is much lower, while underlying inflation is much higher. Now, one thing that is quite striking, I look at the exchange rate and I look at prices in the economy. Now, let me tell you something. I'm not a user of very fancy personal care. I walk into Discam and take whatever I can get, whether it's aftershave or whatever. But I'm amazed at the relationship between the exchange rate and personal care. Most of our personal care is imported. So the exchange rate depreciates, you see personal care inflation go up. And that's part of the problem, that that is why core goods inflation is high, because of the import content of core goods. Now, on one side, I talked about the impact of load shedding on the productive potential of the economy. On the other side, we have done some estimates of the impact of load shedding on inflation. So we estimate that it has an additional impact of 0.5%, and in total, and that has to do with what you all are seeing. Businesses have to have generators, perishables in particular. So where the impact is most stark is in the perishable area. Little supermarkets have to invest in generators. So we hit from both sides. We hit from the inflation side and from the productive potential side of the economy. I don't want to get into this, but this gives you a sense of, South Africa reduced its repo rate to 350 basis points at the beginning of COVID, and we had to increase it. Unfortunately, it's a very technical concept that I talk about here, is what is called the real repo rate, which gives you an indication of how tight or loose monetary policy is. By this criteria, we don't think we're very tight. Now, I talked about the monetary side of the economy. So the big thing about the monetary side of the economy is the success story of this country was that when you had the great financial crisis, there was this search for yield. Investors were getting very low return in the US. And the success story is that the non-resident component of investment in South African bonds went up from something like about 10% to about 40% at its peak. So what it does is it basically says that non-residents are owning South African bonds. That compresses premiums of your yield curve, and it means that the cost of borrowing comes down. So this is what we saw. We saw that under the great global financial crisis, we had this massive increase in bonds. And the blue line shows you how that was happening from 2012 to 2014. But now, from a peak of 40%, non-resident ownership of South African bonds have come down to about 20-25% of total ownership. Now, it's not only idiosyncratic. As you know, the Treasury bill in the US looks very good. The returns are very high, so looking for more safe investments. It's not only South Africa that has experienced the outflow, but it are many other countries. But our idiosyncratic risks has intensified that in a way that is a bit unusual. I put in two other things. One of our roles in the SARB is not only to maintain price stability, but also financial stability. So we look at what's going on in financial markets. The SARB is what I call the market maker of last resort. We play a very important role in ensuring that our financial markets are stable, and I think that's a real positive for an investor in this economy. So this gives you a sense of the outflows of capital. And you must remember, when you have a current account deficit, and when your savings when you're saving, your income is below your expenditure, we import capital. How do we import capital? Through people investing in our equities, in our bonds, and so on. And the moment there's a net outflow of capital, this puts a particular strain on the economy. But we have an incredibly sophisticated economy. We have, by emerging market standards, one of the most deepest liquidity markets. So that also partly explains the behavior of the rand, of which I will come to. I'm almost done, until I can see you that look. That look is saying you should be finishing up. Let's make no pretense to the fact that the rand took a particular knock, and the higher we're going up, the worse the performance. So you can look at the ZAR compared to the average EM currency and a few others. And that knock happened particularly in the last month or so. Now, I've just put forward a list of what's explaining the risk. You know, this slide has to be treated very carefully because, you know, when I say that investors are concerned about load shedding, they're concerned about the fiscus, slippage in sovereign rating. They're concerned not because we're the worst. It's from where we were that, you know, South Africa has an incredible infrastructure by any measure. But what has happened is that infrastructure has deteriorated over the last couple of years, and it's the starting point and the decline from the starting point that is a concern. And I think that you know, I was asked I think it was last night on SABC, what would improve the rand? Can the SARB play a role? And I said that, you know, the SARB's role is probably insignificant compared to government giving more clarity on its position on, you know, Russia, or government giving more clarity on how it decisively wants to deal with load shedding and so on. Those are the factors that are driving the rand. But the rand also has a very special place. It is the proxy rand. You know, they used to say Mexico, the Mexican peso and the South African rand were the proxy. So whatever happens to them is a proxy of what happens. I think the rand has become the authoritative proxy. Someone asked me a question now the other day. Why is it that Turkey has a 50% inflation rate, but its currency is not weakening as much as the South African currency? And I say the big difference is that the Turkish central bank has eroded its reserves to a very dangerous levels by selling dollars. And by selling dollars for more lira, it creates demand for the lira. So it's artificially kept its currency up. We are totally free-floating exchange rate, so our exchange rate is more volatile. So when you compare our currency with others, there are a lot of little technical factors that one has to take into consideration. But, you know, I've raised a lot of things. I know there's a discussion. I can follow up on some of the issues I've raised in the discussion. So let me end there. Thank you very much.
And his first question comes from that slide. Very interesting indeed. Thank you so much, Dr. Rashid Kassim. Rashad Kassim, there's a lot to talk about on your insights today, especially why is it that the currency is doing things that we didn't learn in university when interest rates go up? So I'm dying to find out how that works. Next up is the second part of our kind of deep dive into the South African macroeconomic environment, and that is our electricity challenge, or crisis as some might say. James Mackay is the CEO of the Energy Council of South Africa. with professional qualifications in engineering and finance. He has got more than 20 years of diverse experience in public and private sectors and has worked across the continent, and he will be addressing us on our energy security challenge. Over to you, sir.
Great, thank you very much, Andile. Greetings are coming through all right. Greetings, Minister, board members, everyone, and also online. And Ralph, it's fantastic to be here. Thanks very much. Rashad, there was a great presentation. Thank you. I think you've covered all the important areas of energy that I'm going to take some notes. I'm going to work on it. But I'm disappointed you haven't got rooftop solar yet and got with the trend and keeping the lights on. I'm going to take also just a quick moment to introduce the Energy Council. We're not as famous and well known as the Reserve Bank. Hopefully after this we will be, though. So the mandate of the Energy Council is the energy transition of South Africa. So it is a national mandate. We represent business, both public and private sector. So the IDC, Central Energy Fund, Petro SA, Eskom, those are all founding members and board members. And really the objective is to unify the voice of business, both sort of in action and investment, because we have got a very long, hard road towards net zero, and we've committed to this energy transition. So we are relatively new, expanding quickly. I came on board last year in November, so we've been building this organization very quickly. Membership is expanding, so very much started off with the mining and industrials. The banks are all on board. The renewables developers are starting to come on board. A lot of the organizations, so the Energy Intensive User Group, the Storage Association, PV Association, some of those, the IBP associations. Telcos are coming on board, so MTN's not there yet. So, Ralph, there's nothing for Mahala in life, so we'll be chatting. Okay, so I'm going to try and squeeze this kind of behemoth topic into sort of probably 20 minutes, and I'm going to talk to it. It won't be death by PowerPoint. I did ask Ralph about the techie portions of this thing. He says a very informed and intelligent audience, so I hope that I won't have too many acronyms and gigs and whats, but bear with me. We can clear it up in the Q&A. So I'm going to cover a little bit of setting the scene, current status of the system, load shedding, the old UCLF, EAF, other generation options, including renewable energy, and then some views around delivery confidence. And importantly, I'm also going to just talk about NECOM and the Presidential Energy Action Plan. I think these are quite important to kind of understand where we're at. So our energy crisis has been a long time in the making, and I think in hindsight we can see that although we had policies to avoid the crisis, really implementation failed us. Load shedding is causing immense economic and social pain, which I think Rashad has very well sort of painted out. And I'm going to lay out an engineering or technical road to end load shedding by the end of 2024. Yes, people will say nonsense, but anyway, I'm going to put that out for you. The critical question, though, is again, will be implementation. Okay. I also do believe if we fail to action the high road, really what we'll see is this implementation and load shedding will stretch probably till maybe end of 2028. I choose this date really because there is a study that has been done. It's not publicly released. I've engaged a little bit on it, and I personally feel it's a little bit overly negative. It really doesn't understand some of the things, but I have an obvious sort of optimism bias sitting in the Energy Council. But I will leave you sort of to think about it and decide. So really what I'll frame is we've got these two ends, bookends around ending load shedding, 2024, 2028. It's very clear the energy crisis has spurred some positive structural changes, these really being sort of real collaboration now between business and government. I think secondly, an acceleration of market liberalization, very important, and then increasing transparency. So Andre de Ruyter's book, I think, is an easy example of how corruption and sort of poor performance has been paraded for all to see and has spurred action. So over the last 6 months as the Energy Council CEO, I've certainly had to embrace the phrase one can't wish for a better past, because the reality is we've squandered the last 6 to 7 years in the energy sector. And so we really do need to take action very quickly, but I believe we can recover more resilient and more relevant. We also can't ignore the state capture period, and this is important because I think it's really broken a lot of the institutional delivery capability and the decision-making specifically in SOEs. And I make a differentiation from the institutional side because I think we've got to still recognize and understand that there are some very committed, very technically competent and capable people working in Eskom as well as in government, and I sort of work and engage with them regularly. And so we need to, I think, create some separation, and we need to think of a way to create a better storyline and to actually protect those who are doing. So this sort of a little bit of an opening backdrop I put against sort of really big external disruptors, COVID-19 and climate change. And climate change really is the biggest global sort of disruptor in history, and the energy transition is fundamental and an explicit part of climate change. So South Africa, we're the most coal-dependent economy and the most emissions-dependent sort of economy hence. Eskom makes up 43% of our emissions profile. So despite this sort of low economic base and high emissions, we have adopted a global leading position on climate change. And so we are the only African country who has legislated 2050 net zero and implemented a carbon tax. So lofty ambitions, but this is a significant challenge even for leading global economies. In the South African context, this maybe is just a commitment that could be viewed as an insurmountable challenge. And I think also talks a little bit to the constant push-pull politics and policy incoherence that has been frustrating and that we have experienced. So despite the cracks in this policy environment and lack of energy transition planning, the upside is that actually the broader reform momentum has really steadily progressed, and I'll talk a little bit about this later. But I do believe that market liberalization really is on the cusp of a big shift, and this is going to really move a lot of the energy development and investment that you talk about, Rashad. It is very exciting. It's going to move into the hands of the private sector very quickly, and it's going to be a positive, I think, for the economy and also for the sector. To give just a reference or some color to the cracks that I referred to, we think of the REAP program, I think was renowned as a world leader starting in 2011. 4 bid rounds successfully done. Stalled in 2016, only ready to be resurrected in 2021, bid round 5. And it's still stalling and struggling despite the commitments for bid round 7 and 8. In the meantime, I think the other side is that our national utility, Eskom, actually got Global Power Company of the Year in 2001. But really then got just trapped into this classic utility death spiral, which is a well-recognized kind of global phenomenon. And then the obvious challenges, 13 CEOs in 13 years, technically insolvent for probably nearly the last 5 years. So, really, really difficult. But Eskom has, in reality, actually been the biggest driver of reform planning and restructuring, from design of independent grid company, adoption of new technology and standards, the implementation of national wheeling, development of the first internal energy market, which are all very exciting. But part of this reform narrative actually also included an aggressive decommissioning of 12,000 megawatts of our coal-fired power fleet, which is roughly a third, by 2030, which actually conveniently aligned with sort of old age. So you won't look at around the room. Sometimes they talk about who's out at old age, but old age is not necessarily a good lead indicator of that. However, nonetheless, when we put this in context, I believe that there's a bit of a disconnect in the environment and where Eskom's core business actually was neglected, unfortunately, which combined with key sort of loss of skills and the broader sort of challenges really is just became a breeding ground for corrupt activities, which is where we find ourselves. So I think a bit of a tough opening position, but as I say, we can't wish for a better past, and we really do need to find a constructive way to move through and move forward. So we'll talk a little bit now about the actual current system outlook, and I'm just going to talk about gigs. Gigs is gigawatts. Hopefully that all makes sense, but it keeps it simple. So winter is likely going to range from stage 4 to 6 load shedding, and I think we will see occasional stage 8. The rumors of stage 16, I think, are really just that. So the stage 16 is an extended technical definition under an NRS code, but it's not related to an Eskom operating outlook or systems planning. Okay. Also, while we're on talking about scenarios, let me also just reference that deeper load shedding doesn't equate to the deeper risk of a blackout. There's been some really sensational media coverage about an impending blackout. I personally am very confident that the risk of blackout is extremely low. Eskom is a highly competent system operator, regularly tests blackout protection and black start procedures. And I think it's also very important technically to understand that a blackout is actually premised on rapid loss of frequency in the system. It's not actually load shedding. And the rapid loss of frequency in the system is actually protected largely through automated protection functions, but is designed to actually island the system. And Eskom actually do test this on a regular basis, and they do have plans for this. So I think these things are quite different, and the system operator is very confident and do understand what they're doing there. They've also recently released a very informative presentation talking about the technicalities of blackouts, etc. We can talk about it during the Q&A, but I think it's just relevant in the general conversation. So coming back to load shedding itself, if we start with demand, it's important just to consider that the summer peak in South Africa is 27, 29 gigs. This goes up to about 33, 34 gigs. So winter has quite a high increase in peak, especially in the evenings. And so there's an obvious view that maybe, in the winter period now, there's a deterioration in the system reliability, which is not actually sort of necessarily true. So in compensating for now, as we go into winter, certainly Eskom have reduced their planned maintenance function by about 4 gigs. This is a big offset. So they will focus only on statutory schedules in terms of maintenance. This does create a little bit of risk in the system because it leaves more volatility in unplanned or sort of reactive maintenance that may be required. So again, we do have to think about that, and hence I say, I think we will have some journeys into the stage 8 load shedding, which is going to be very tough, but really we should be able to stay at between 4 and 6. On the Eskom demand side, again with those winter peaks, especially in the evening, there is a demand program which Eskom have. They have also are busy rolling out a communication program. And the other part of the demand program is a buyback scheme, and this is targeting about 1.4 gigs of demand reduction, especially in the peak, and it's already showing kind of good progress and yielding results. So I think that's positive. If we switch a little bit then into the unplanned losses, and this is where everyone sort of talks about the energy availability factor, or EAF. So the installed capacity of 47.5 gigs, Eskom is running at unplanned losses of about 16 to 17 gigs, with 19 gigs essentially being the equivalent of about stage 6. So we're sitting in that stage, sort of 4 to 6 load shedding stage range. 2022 was 56% EAF for the year. This has declined year to date to 51% in 2023. The official plan in Eskom, and so this is, sometimes we hear different plans out of different ministries, but the official plan in Eskom is recover 60% by March 24 and 65% by March 25. Actually, this is enough to end load shedding. So again, it comes back to confidence around implementation. Incidentally, 2015, the EAF of Eskom was 74%. So again, I reference this lost period that we've got to recover. I think to also just understand a little bit better, and certainly what we're working with now is that we have to break down this EAF global number. What does it mean? So the first thing, if we look at the return to service units that are out. So there's about 5 gigs of capacity there. We know it's the Kusile 3 units on the duct failure. Those are targeted for return by December this year. Kusile Unit 6 will be back in commercial operations Feb 24. Medupi Unit 4 is the replacement generator. That's targeted for August 24. Kuiberg, both units midlife refurbishment by November 24. So collectively, the return to service plants should be putting back operational capacity, not total capacity, but about 2.4 gigs sort of this year in the next 12 months, and then another gig in the sort of by the end of 2024 in those programs. So that's about 3 to 4 stages of load shedding that will be addressed by the return to service units. If we quickly just look at the older coal fleet, and really I'm just looking at the 10 old stations. So the best performing stations, Letaba and Matimba, combined capacity of about 8 gigs, strong performance, good availability. By contrast, the 4 worst performing stations, Tutuka, Kendal, Majuba, and Duva, combined capacity of about 15.5 gigawatts. Kendal, Majuba being actually the younger stations, under 30 years, but operating at really poor performance levels. Tutuka in the low 20% range. So these 4 stations making up nearly 60% of total unplanned losses for the Eskom fleet at the moment. So one can see, underneath this global number that gets put into the media, that there's actually a very different sort of technical situation. So to recover the operating performance, Eskom has launched a targeted power station improvement program. It's being led by the new head of generation, Becky Khumalo. Becky has a deep experience. He's been a power station for many years. He talks the numbers and he says, no, that can't be. Those tube failures didn't happen. Go look at the numbers again. So I think really great to have a steady hand. I think it's already making a big difference. And we see really a lot of the focus is around stabilizing leadership and management at the power station level. And this is where we have to focus, I think, to get this right. What really kind of does give me sort of more confidence, though, is the business Eskom teamwork, which is starting to take shape. I spoke about this partnership, and under NECOM, I think this is really starting to move. Where business is supporting Eskom to action a number of specific technical challenges. So working with Eskom, we've actually identified 4 power stations with key issues, things like mills, ash handling, demon water, strategic spares, that actually are targeted to continuous losses of nearly 3.5 gigs of power. So I go back to the sort of earliest reference to institutional capacity to implement these remedial actions, which is just, I think, lacking. We've lost this in this middle period. And right now, we've got to find a way to get this up and running, but we don't have time, so we need to support. And NECOM, I think, is working into a really good action-orientated vehicle. And we are hopefully going to have about 3 teams, business teams on the ground within weeks, working with Eskom, focusing on specific technical sort of issues with a target in mind. So we know what the gigawatts are that we can put back on the grid. So I think that's a really positive sort of action orientation. And when one looks at those plans, it looks at about in the next 6 to 12 months, if we can address those, there's another 2 to 3 stages of load shedding we could put back. Just quickly switching to external power being purchased, and I think this is where we need to think about how market liberalization is going to be an opportunity also for the private sector. So there's a rapidly expanding source of direct purchases from private generators. So actually, when I said, Eskom has just quietly got on with a lot of the reform, they've already established an internal market where generators are bidding against each other. This is being expanded now to include external supply. So the market mechanisms are the standard offer, feed-in tariff. They've just launched an emergency generation program and also regional purchases from the SA Power Pool. This is it's a significant reform step because it creates this platform for the first South African wholesale energy market. And so when thinking in the concept of energy as a service, which is going to be the future, it's actually something a lot of companies, even like MTN, chatting to Charles, I think you're building that resilience in the network already. But now you'll be able to sort of target a developing marketplace. So I think credit needs to be given actually to some good and hardworking, clever people in Eskom who've been driving this reform work. They've already contracted some of the first private generators who are bidding in on static and dynamic pricing. So they have got a real day-ahead market, week-ahead, monthly. So it's quite remarkable that they've managed to pull this off with probably limited support also and limited support from NERSA. But it is an exciting development, and I think can unlock probably about 1.5 gigs of power in the next 18 months, which I believe, once it's brought out in the new national transmission company under the unbundling, that is going to be the market, and it's going to expand very, very rapidly. A quick switch just back to the OCGTs, or the diesel peakers as we know them. In the short term, this really is the only quick lever that Eskom has to pull. We've got 3.1 gigs of these diesel peakers. A big challenge is being able to get enough diesel through them. They're not designed to be able to cater for the higher levels of utilization. And this has been a challenge for Eskom. So securing this reliable diesel supply. Again, we have a business Eskom team on the ground starting on Monday, which is going to look at sort of trying to optimize and improve the reliability so that especially during the winter period, Eskom can kind of reliably run at higher loads, and this will put an additional approximately 500 megawatts back into the system operator's pocket, which I think will help with load shedding again. Lastly, I'm just going to look quickly or touch on renewables because that's a little bit of sort of outside of the Eskom purview. So We know that through the proposed public procurement bid windows, which there's been some bullish statements on that, but I think also really what we've seen is the big acceleration is in the private sector direct investment, so in the form of corporate PPAs and behind-the-meter solutions, also some of and the rooftop solutions. So we're seeing a really rapidly expanding rate of wind and solar development. And despite the grid constraints and other sort of issues that we're facing, I believe we're fast approaching about a 4 to 5 gig build sort of rate per annum. This will make a huge reduction in terms of load shedding and creates an energy buffer for that sort of extended Eskom maintenance that they need. So I think a very positive. To give you a sense of the numbers of this, the renewable energy pipeline at the moment, Eskom have issued about 58,000 megawatts of cost estimate letters for grid connections. And of those, they've got 13,000 megawatts or 13 gigs already in budget quotes. So those are projects which are actually kind of going into being built. As impressive as this sounds, as the Energy Council, we've made a call for a 2030 energy ambition of actually 56,000 megawatts of wind and solar, 8,000 megawatts of storage, 5,000 megawatts of gas to power. If we could achieve that, that would give us the energy stability and headroom to decommission the 12,000 megawatts of coal, which have been targeted in our emissions profile. The reality is I think we're well behind that ambition of energy, and so I think that really what the reality of that is we will have to see a delayed coal decommissioning program as a trade-off to keep the lights on. That is something probably which we'll have to deal with in the planning, but in terms of the reality of the system, I think that's where we're at. Just some other, I think, key reform indicators which are worth noting or highlighting is the ERA amendment, which has gone through Cabinet, now sitting with Parliament, really essentially legislates the liberalisation of the energy market and non-discriminatory access to the grid. So this is a real positive. But there are other things, the tax incentive for residential solar, an aggressive 125% write-off for businesses, support fund for agricultural energy, embedded generations, all gazetted as SIPs. And then the National Transmission Company is now registered with SIPs. As a company, NERSA will, I think, finally issue the license in the next 2 months. And I believe that we will see an unbundling of Eskom as a transmission company before the end of this year. This is going to be a really big signal and I think an important shift and move in the reform of the energy sector. So I think very positive and will help to deal with grid constraints. So in summary, based on the opportunities outlined, I think we can quickly add up the opportunities there, and we get to about 9.5 gigs that we could realize over the next 18 to 24 months. This plus the ongoing renewable program clearly can end load shedding. Going back to my opening remarks on implementation, the obvious question is what needs to be done to keep tracking delivery on the high road, which is where NECOM, I think, is presenting a positive structural shift in collaboration and action. I'll quickly just give a sense of NECOM. I think it's very important, but as I said earlier, the energy crisis really has created this burning platform and triggered an engagement between business, the president, and a number of ministries, and all were in agreement that we really have to work very urgently in partnership. So under the Presidential Energy Action Plan, the National Energy Crisis Committee was formed, that's NECOM, and it's being strongly supported by business. Businesses have established the Resource Mobilization Fund, which is 100 million rands worth of professional services that are going to be mobilized into supporting NECOM and to get that moving. There are 10 work streams structured in NECOM, and the structure now is working collectively or at the table, business, government, and Eskom. And so there are a number of initiatives there, as well as a few of the key dedicated work streams. One is the power station performance, which we're calling kind of the EAF recovery. And this is where I referenced earlier, we've got business teams. We're hoping to probably have joint business Eskom teams on the ground within the next weeks. And I think very positive working relationships and really getting into the sort of the meat of the challenges. We've also got other work streams and focus areas. So work stream 9 is market and wheeling. Big focus there, trying to unlock national wheeling, municipal utilities. This is a very important part of the recovery plan. We've got to bring the municipal utilities into the reform program, which I think they've been left out up until now. And then workstream 10 is on grid. And I think everyone understands grid. a very important part of the reform program. So in conclusion, Andelia, pleased to see me go. I think we're going to experience high stages of load shedding in the immediate future, but we do have the structural capacity to largely end load shedding by end of 2024. So I think that's a very positive opportunity. However, it's going to require a really big team effort. It will require government, Eskom, and business to work kind of well and really focus. But we're already seeing positive traction. Maybe thanks to the crisis, it's forced this. Without the collaborative approach and the focus and mobilization of capacity, business as usual is likely to be somewhere closer towards 2028, which we can't be an option for us. In more general terms, I think it's also unlikely that we're going to see big shifts in policy direction and pace. But the reality is the electricity sector, I think, is sufficiently deregulated actually to allow a rapid market response and drive exponential private sector sort of investment, which I've referenced. So I think that there's some mitigation there. And at the end of the day, the Stone Age didn't end because it ran out of stones. It ended really because society chose a better way to live. And so I think we need to think along those lines. But thank you very much.
Thank you very much, Mr. Mackay. All I heard there was that load shedding ends at the end of 2024. I'm now going to ask Dr. Rashad and also Ralph to please join me for our panel discussion. Gents, grab any of those, just so that we can distill some of the stuff you all three have already shared with us. Let me just remind you all, especially those at home that are joining us, or in the office, that are joining us via webcast. Just at the bottom of your screen, there's an opportunity for you to load your questions. I'll be receiving them here on my device, and I'll be able to send them to the gentleman here on my left. And everybody in the room, we've got roving mics that are on standby for you. So just simply raise your hand when I give you a chance, and you can pose your question as well. We've got a couple of minutes to get through as many questions as we possibly can. And I'm going to kick off with you, Ralph. You've heard Dr. Rashad, you've heard Mr. Mackay promising us end of load shedding, end of next year, which I'm absolutely thrilled about. But both of them have given a landscape of what's happening in South Africa, right? From a macro and also this particular challenge. What are your reflections on that?
Yeah, maybe a couple of points with an MTN kind of lens on it. I think the first thing is that we at MTN have taken a position that we do think we need to take matters into our own hands really around load shedding. And I think we came to the market with our results and said we're taking a particular view that we're going to be in sustained stage 4 plus. And therefore we need to ensure that the network in South Africa is resilient for that outlook. And as the data sets you've seen have shown, is that the load shedding really creeped up on us very suddenly. And 3 or 4 years ago, you'd have said, well, what's the likelihood of stage 4? You'd have said it's force majeure and so. So I'm heartened by what both of them have said, because actually our own planning and framing is within that bookends that says, somewhere between 2024. Would love to believe that it's going to get there 2024, but we're being a bit more conservative and putting the investment. And also importantly, and I think it's a point that James makes, is really this point that actually the investment you make in energy right now, actually you should think about it with the opportunity it creates, about energy markets and the liberalization. So Charles and team are already thinking about, and investors can ask him some questions tomorrow. So we're being real about the situation, and we've changed our guidance to reflect the reality that we see. I think the second point I'd make is that we're not standing back as business, and I think there's a lot of criticism that business is not leaning into the situation. I think we're trying to do a lot of work behind the scenes and engaging the government. James and myself and a few other CEOs are members of a CEO group that's been meeting since January with a focus on 3 major themes. The one is the energy security and how we engage government to deal with this 6 gigs issue. I mean, the bottom line is if today it's 6 gigs in the net, we wouldn't have load shedding. So how do we work with government towards ensuring that? So that's the energy security is theme number 1. Theme number 2 is what Rashad spoke about, which is logistics. So we talk a lot about load shedding, but just go back and reference the chart on capacity for rail, and you just see everybody's now using the roads, and you see the infrastructure. So there is a real bottleneck on the logistics side. So work stream 2 is the logistics, and the third one is crime and corruption. In our engagements, we've said, look, it's not enough to talk to business about the problems. We have to come up with solutions. So the solution issue is really about jobs. Can we create 300,000 jobs? What will it take? What's our role in business? So I think the other point, the point to make is that we're not sitting behind. I know there's a lot of criticism but actually there's significant engagement, and actually there's an engagement at the presidency level, with CEOs.
Lovely, lovely. That's really encouraging. Dr. Kasim, let me come to you. I said it jokingly about what the currency has done since your very unpopular decision of raising interest rates last week. The rand weakened. We were all surprised. Then yesterday, it slumped even further. So either I was in the wrong class or something weird is happening. What's going on?
So was I. I think that firstly, the worst predictors of the rand are economists. Part of the problem of making sense of what drives the rand is there's just so many moving parts, a multiplicity of factors. So at the time when the Monetary Policy Committee announced the 50 basis points increase, the rand weakened a bit because U.S. Economic indicators looked better. And what that meant, by economic indicators looking better, it means that the U.S. is going to continue to tighten to keep inflation in check. So that has had a negative effect on the rand. I think that when we came out, the market expected a 50 basis points tightening. I don't know what would have happened had we had the counterfactual, a 25 or a 75. But I think that there was something in the statement that worried the markets. Maybe we were a bit more explicit than we should have been about our concerns about the weakness of the rand. And I think the market took that in a negative way, that, actually in our model, we assume that the rand will actually improve. But in the current moment, we assume that there's some upside risk to the weakness of the rand. So I think we were the bearer of bad news. The market felt that our assessment of the economy was more negative than they felt. So that could have been some of the factors that may have led to a slightly. I think that the recent example you're looking at is, people are just nervous. The people investors draw in their mind, what are the implications of a secondary sanction? Every time government does something which indicates, that we have a very ambivalent view about what we think of Russia, the rand takes a knock. So there are all these factors that just make it very difficult.
Before you wrapped up this morning, your slide about South Africa's idiosyncratic risk, the first two bullet points were quite interesting, and I'd like you to elaborate because I know you were running out of time at the time. Elevated levels of load shedding known, covered by James, and a risk of grid collapse not fully factored in, which I'll ask James about. But the second point was interesting for me, which was you mentioned the high risk of SA listed and the risk of secondary sanctions. What's your take on what that could really lead to if it actually materializes?
So we have a living example, and that's Russia, right? The living example is that it cannot trade. It is off the SWIFT system. Russia has actually developed its own payments infrastructure, which means it can trade internally, but it's extremely hard to import goods. There's the other thing. There's the highly politicization of finance, where some of its reserves are frozen. So that's the extreme. I think that the concern with secondary sanctions is it becomes harder for the financial sector to do business. There's an extra layer of documentation required. There's concerns that it'll be, that maybe there'll be a boycott on some of our trading partners. Most of our investors, if you look at our breakdown of foreigners owning South African equities, foreigners owning South African bonds, they come from countries that are closely aligned to the West. They could go on some, on a bit of a strike, so pull out some of their investments. So I think that's the kind of thing that we had a press conference on Monday night where we launched something called the Financial Stability Report. And the aim of that was to flag secondary risks as to what it means for the financial system And that's, what I can talk about, what it means for the financial system.
Absolutely. Thanks, Dr. Kasim. Mr. Mackay, let me come to you. Direct question. Your view on the likelihood of a total grid collapse?
Yeah. So in very simple terms, one can't say none because it's possible. There have been many grid collapses and blackouts internationally. Even the US and Texas had a grid blackout. So one has to understand that there are sort of circumstances that can lead to a blackout. So that's possible. The question is, are we at a stage where our system is collapsing and we can't protect against that? No. Do we have an incompetent system operator? No. If it does happen, do we have no plan to recover it? No. So I think part of the media hype around this blackout has been that we have an incredibly negative sentiment and narrative in the energy space. There are many, many groups who are just looking to kind of almost jump on anything and bash everyone from Eskom, from fossil fuels, from government. And understandably, there's a lot of frustration. There's a lot of pain in the system. So I think we have to put that in context. And then it was just a matter of time before kind of blackout was going to be the next thing to grab onto and sort of rattle around. But from a technical perspective, we are no further at risk of blackouts than what we were prior to 2015 when things were working well. I think more what we have to think about is at deeper stages of load shedding, if we had to go be at a stage 8 or something like that. The reality is that the average person in the street doesn't see a positive or constructive narrative of how this is going to end. They don't understand the bookends. They haven't seen the bookends, and government is not telling them about the bookends. So people are going to sit there and go, wow, I'm out of power for 12 hours a day, 14 hours a day, so I don't know. I give up. And I think that is what we've got to address. It's not the blackout. It's going to have to be a messaging to society that there is hope. We can get through this. There's a lot of constructive things that are happening, but the average person just sees kind of almost darkness. So maybe there's an interesting parallel there between darkness and blackout.
Maybe dark, but it won't be black. Ladies and gents, let me take some questions from the floor. I'm pretty sure many of you guys have got some views. I've got a gentleman. Please keep your hand up, sir. Here we go. Please, just your name and the organization you represent.
Sure, thank you. It's AJ Snyman from Peregrine Capital. I have a question for Dr. Kasim. Thanks for your time today, and I think I speak on behalf of most of Africans in thanking the SARB for your dedicated and disciplined work. I understand that the SARB's mandate is inflation, and the only tool, well, the best tool you have at your disposal is interest rates. And I hear what you're saying about the fact that South Africa is not unique in the context of the global inflationary environment, but I would like to argue that perhaps indeed we are, and maybe put it to you that inflation expectations is all anchored around load shedding, the cost that's pushed through the system because of load shedding. So in that context, do you think that the current hiking cycle that we're in, or the stage of the hiking cycle that we're in, is actually an effective and efficient tool for our specific inflationary environment in South Africa? Thank you.
Yeah, look, at the end of the day, using interest rates to manage inflation is a crude tool. It's the best tool we have. Just to say that, what drives inflation expectations so for those of you who don't follow this, that a mark of a successful central bank is when expectations about inflation are anchored. So what does that mean? It means that if you have a shock from the oil price or you have a shock from food prices, and it's temporary, in other words, inflation goes up from, say, 4.5% to 12%. But if you believe that this central bank is credible, it will not allow inflation to stay at 12%. It means inflation expectations are anchored. It means we don't have to use monetary policy to tighten, because that will be temporary. It'll come back to 4.5%. Now, directly speaking to your question, I think that the big issue that the public has with us is how on earth could you tighten by 50 basis points when real estimates of real disposable income of households for this economy for this year are kind of 0.5. Now, the argument is as simple, and we don't have the luxury of getting to the detail, but the argument is very simple. Expectations are driven not only by load shedding. That's a more recent phenomenon. Expectations are driven by the fact that, you're a contractor, you're a construction company. Oil prices are going up, food prices are going up, the exchange rate's depreciating, so your import costs have gone up, and now you're pricing in more high inflation into your 5-year contracts. But maybe you're pricing in higher than you should, because you don't believe expectations are anchored. So the best monetary policy works best when the economy is overheating, demand outstrips supply, you cool the economy down. Here, it's a very, very crude tool. But I think the logic of our system is that if you don't make the tightening now, if you slowing down the economy at the rate that we may be by tightening, by not trying to keep inflation in check, we may have to slow down much more dramatically in a few years' time. So so let's say that for the last 3 MPCs we didn't do anything. It may well be that a year down the line we may have to tighten by 400 basis points. So I think that's the logic of it, but it's a big debate we have with the analysts.
I'm sure it is. I'm sure it is. Let me go to my webcast right now. Maybe turn to you, James. Mike Ferry from the Cecil Pension Fund has a question about the risk you already highlighted, is about execution. I mean, Ralph has already touched on what CEOs and businesses doing to create the right kind of lobby platforms to get everybody doing. But at some point, the buck stops with somebody. So Mike is asking, what are the key factors underlying either good or poor execution, and who is ultimately responsible?
So I think at the end of the day, it's Eskom. Eskom is the only entity that can really make the decisions, sign the check, and say, kind of do whatever. So we mustn't forget that the people who are on the ground making the decisions, running these things, are Eskom employees. So I think that's where we have to focus. My personal view is that there are, I think that we've seen a very different Eskom starting to sort of come out. There's a different narrative, a more positive, we're going to recover, we're going to do stuff. I think some of the reform things that I spoke about are supporting and helping that. We do need to change the broader context of the Eskom bashing and start recognizing some of these pockets of excellence and supporting Eskom. When it comes to then the do versus the not do, we've got to again just reflect in this lost period, 6-7 years. There's just not enough technical capacity left in Eskom. And not everyone is a pocket of excellence, because that's also a bit of a legacy of the system. So in the short term, we just have to create capacity around those pockets of excellence. We know what needs to be done. We've just got to get done and find a way to do that. I think that will buy us time to kind of get through load shedding, and we need to then start having a strategy of what is our future utility going to look like. Internationally, they're great public and private utilities. They compete head to head. We have very different structures in energy markets. We don't have a clear vision of that. And so we've got to find that and find a sensible, sustainable place where Eskom is going to move towards. And I don't think that's been defined for Eskom. It was reform to this and just leave this somewhere to just decay. And that was never sustainable. And I think we've got to rethink that strategy around that.
Let me take couple more from the floor. Yes, sir. I'll come back to you, sir.
My name is Sunil Verghese. I'm from the Public Investment Corporation. One question for the Deputy Governor there. You were talking about secondary sanctions. So one thing that comes to mind is earlier this year, the Financial Action Task Force grey listed us. So can you give us some insight as to the steps that we are taking to reverse that? And when do you think we could be removed from the grey listing? Thank you.
Before Dr. Kasim comes in, let me take that gentleman, and then we'll just answer both questions and wrap up this section. Yes, sir. Right there in the middle.
Hi everyone. It's Prashanda Nadeya from Nedbank CIB. I've also got a question for Dr. Kasim. You mentioned that South Africa's investment as a percentage of GDP is relatively low at 14%. How do we get that up in a rising interest rate cycle now that your cost of debt is increasing and your cost of equity would also increase on the back of what the Energy Council is also talking about higher costs to actually run businesses during load shedding. Just your thoughts on that. Thanks.
Thank you, gentlemen. Sir.
Yeah. On FATF, I should say that my colleague, the Deputy Governor, the regulator Fundi Tajibana, and the Acting Director General of Treasury worked extremely hard at FATF. And by the time we were grade listed, I can't remember the numbers, but there were maybe something like 25 issues that FATF had raised. By the time they got to the assessment, they were limited to maybe something like half the amount, which shows that the country really, really worked hard at trying to deal very decisively. There was an incredible team that did this. I think that the FATF did identify a few issues, weaknesses in our prosecution services, and the broader issues around money laundering and so on. So I can tell you that the financial sector remains a very credible and robust sector in this economy. It is one of the kind of leading areas where I think that one shouldn't worry. How long it will take? I think these things take a while, 1 or 2 years. I think there are a few countries that have worked with it, but I'm not exactly sure how long that could take. So the issue of interest rates, I mean, there is a school of thought that when you tighten, you make the cost of borrowing much more expensive. How can you accept investment to grow? But in fact, interest rates play a very small role. It on the margins helps you make your decision. Are you going to invest or not? Excessively tight could be very, very dangerous. I think that the real problem is confidence, and confidence is not about monetary policy. It's about firms having the confidence to invest in this economy. I think that one of the areas that need a lot of attention is the difficulty that firms have in local municipalities. Many firms are feeling the brunt of being able to do business in this country when we can see what happened with Clover in a little town, Lichtenberg, because everything was going haywire. So I think that there's so many, from business confidence to sorting out so many things before you can get investment going. So I think that's really the issue. I think that the SARB, by being preemptive, may be able to kind of keep inflation in check. Once inflation goes down, interest rates go down.
All right, ladies and gentlemen, we're going to wrap it there. Round of applause for our panel. Thank you, guys. Right, lots more to talk about. Thank you, gentlemen. Thank you for giving us the time and also the time you've taken to prepare for these presentations. It is now lunchtime. I know it sounds early, right? Because you probably had lunch before you got here. But we have lunch for you, okay? It is now just gone 13:38. We're going to give you about 40 minutes to enjoy a bit of lunch. Also, in the area where we'll be having lunch, there's a whole exhibition on a couple of things. I know the MTN Group ESG team has got a bit of a demo there for you. There's a couple of organizations that the MTN Group supports. I know that some of the gifts have already been handed out that are being supported by some communities in the underprivileged communities of our country. They are exhibiting a few very interesting initiatives, but please interact with that. And also the initiatives that are within the MTN Group around digital services and what Ralph has already touched on, which is the future of our continent being driven by digital. I need you back in this room in the next 40 minutes. So that will take us to 2:20. And at 2:20, we will then kick off the second session, where we'll be going deeper into two other markets on our continent, being Nigeria and Ghana. Enjoy lunch. Ladies and gentlemen, welcome back. I hope you enjoyed your lunch break. I saw many people, when the beat came on the first time, some people were still a little confused whether that meant they must come back. But well done for doing the best you can. We're going to move on with our agenda. We've got quite an action-packed one for the rest of the afternoon. In a few moments, we'll be hearing from Razia Khan, who's the head of research for Middle East and Africa at Standard Chartered Bank. And then we'll get into two of MTN Group's largest markets, being Nigeria. We've got a couple of invited guests that will be sharing some insights with us. And then also the other market that is just as important, if not perhaps a bit more in terms of prospects, and that would be Ghana. And we'll talk a bit more about that. It is actually the center of the Momo product that MTN has got, as you know, and rolling out in all the markets. And Ghana seemingly has had the greatest traction in recent times. We're going to hear about that. And then that will be the wrap-up of our day. So to kick us off, let me introduce you to what is hopefully going to be quite a comprehensive review of the performance and prospects of the Sub-Saharan Africa region, coming from, of course, Razia Khan. You might know her very well. She's the head of research at SCMB. And she's been there now for a couple of years covering Middle East and Africa. She's got over 2 decades of experience covering emerging markets and frontier markets, and of course, a well-known commentator on our region. She did do a pre-record for us. The lights will be dimmed and the screens will be on. So kick back, relax as she takes us through the current trends and developments that are happening in our region and to what extent that might affect the prospects of the MTN Group. Ladies and gentlemen, Razia Khan.
Good day to everyone who's joined this conference. I'm going to be presenting to you the Africa Economic Outlook as we see things right now. If we could move on, please, to the very first slide, which is tighter global financial conditions have a negative impact on the outlook. We know that there's a lot of focus on this at this particular point in time. When we look at sub-Saharan African growth, the region has been impacted by a series of negative shocks that happened in very quick succession. Not only had we had the 2014-2015 commodity price slowdown, concerns around China's growth and the sustainability of that growth early on, but this was followed in quick succession by, in 2020, the COVID crisis, the impact of global tightening as everyone recovered, and it looked as though inflation rates in developed markets were much stronger than even central banks had anticipated. The tightening that was necessary, the inflation risks compounded by the Russian invasion of Ukraine, the impact on food and energy prices, and an even further tightening of global financing conditions still. The IMF and others have often remarked that at any one point in time, even one of these singular shocks would have been sufficient to disrupt African growth. Nobody would have imagined that we would have seen all of these various shocks impacting at the same time. I'm going to talk you through a presentation on how we see the outlook going forward. So moving on to slide 3 of the presentation pack, please. The first chart I would like you to focus on is that relationship between sub-Saharan African growth and global growth. We know that when we look at the global economic outlook, this is a time of significant uncertainty, that we have seen a lot of tightening, an unprecedented speed to that tightening in some respects from global central banks, both in developed markets and in emerging markets alike. And this is bound to have repercussions for the growth outlook. We also know from history that any time there has been a global shock, growth in sub-Saharan Africa has been impacted with some lag, that typically it's only a year after the global shock is felt that the full effect is transmitted to sub-Saharan African economies. And it looks very much as though that post-COVID 2021 recovery in growth now looks to be at risk of being significantly disrupted. Moreover, if the calculation is that we are going to see tighter monetary conditions, tighter external financing conditions remaining in place for African sovereigns for some time, this would be a fair assumption, then it becomes very difficult to focus on what the drivers of future growth could be. Moving back to the second chart that you see before you on slide 3 of the presentation, this looks at the relationship between global food prices and inflation in Africa. For much of the rest of the world, they're over the worst of the global food price shock. In year-on-year terms, food prices have started to trend down. Energy prices, also reflecting the expectation of a growth slowdown, are also weaker. But this comes as a source of very little comfort for African economies. What we're generally seeing across the region is that the lagged impact of those shocks is still playing out for individual economies. Moreover, it is often compounded by foreign exchange stress. The fact that we've been in a strong dollar environment for so long that African currencies are largely still weakening against the dollar and other global currencies means that this is something of a more prolonged inflation shock. We should not forget that food contributes around 40% of consumption baskets in Africa in general. So there is little point in downplaying the impact of any food-related shock. The inputs for agriculture remain very expensive in local currency terms. There is little comfort that we're getting from the scale of domestic harvests that things are likely to improve very meaningfully. And all of this means, for a variety of reasons, inflation in many sub-Saharan African markets remains elevated. Not only do we have difficult growth conditions, but this means that for the region's central banks, many are still in a tightening cycle. They do not have the luxury of adding at all to policy accommodation to try to ease the way through this likely growth slowdown. And this just adds to the difficult conditions that the region must contend with. Moving on to the next slide, slide 4 of the presentation. What can we say about the recent growth trend? Well, 2021 was broadly a year of recovery for the sub-Saharan African region. Even as we saw many economies still having to deal with the long drawn out effects of the COVID shock, nonetheless, the reopening in developed markets was a source of external positive surprise for many African economies. Commodity prices recovered. Growth in those developed markets initially seemed to be bouncing back more strongly than many had anticipated. And that external demand no doubt contributed to conditions that saw a bounce back in African growth. But let's look at what the more forward-looking survey data is telling us right now. And that is, if you focus on the blue dots on this particular chart, the most recent PMIs for the region, you'll see that across the different economies, there is a mixed picture. In many instances, the PMIs have been struggling to hold up above that crucial 50 level. That would typically denote the difference between contractionary or expansionary conditions in the economy. And the takeaway is that because of the magnitude of external stresses, concerns about a global slowdown, concerns about how governments are able to finance or refinance their maturing debt obligations, central banks having to keep monetary policy still very tight, problems to do with the availability of foreign exchange and dollar liquidity in many instances, that all of these different factors have been playing out as well. And the survey data tells us that in many instances, this is leading to quite a negative turn in terms of business sentiment, notwithstanding the growth recovery that we have so clearly seen since the COVID years. Moving on to the next slide, slide 5. There are a number of charts that I would like you to focus on here. The first one is simply a rebasing of different African exchange rates to a single starting point, January 2020, and you can observe the performance against the US dollar. Now, there's one very important point to bear in mind when interpreting this chart, and that is that in some instances, FX rates don't seem to be very volatile. Nigeria, for example, the official FX rate has hardly adjusted. That in itself is part of the problem. We have seen, alongside accelerated Fed tightening, at Standard Chartered, we believe we're now seeing the peak in the cycle in terms of where US interest rates are. Nonetheless, that has fed into a strong dollar environment. And very few economies have been immune to that strengthening of the dollar. We have seen a pronounced amount of FX volatility in many different African currency pairs, and where it doesn't show up on the chart, that often hides the fact that we have non-functioning markets, where whatever levels you see in the official FX rate in official FX markets are very unlikely to be market clearing levels. This is part of the problem. In economy after economy, the supply of dollar liquidity has been that much more constrained. Those currencies that are still relatively flexible, those countries with the benefits of a flexible exchange rate, have generally been spared the worst of the growth pressures because they still have functioning FX markets. But an increasing number of different African FX markets have moved from better functioning to less well functioning as they have had to contend with these dollar liquidity pressures. And this is the problem. As a consequence of those global shocks and a still very difficult global external environment facing African economies, it's not clear where the supply of dollar liquidity is necessarily going to come from. In many instances, significant FX adjustment is still very much required, and this will need to be watched very carefully. Another chart on this same slide that I want you to focus on now is this one of Euro bond spreads. We know the story. 2020, a global shock disrupted the world's economy in a way that very few of us had ever imagined could be the case. The simultaneous lockdowns, the seizing, essentially, of global economic activity, a slowdown that we wouldn't have been able to contend with just a few years ago when we thought the global financial crisis was as bad as it got. Accompanying that situation, the COVID shock, was a withdrawal of capital from many so-called perceived to be riskier markets. In Africa, we saw this reflected not only by the withdrawal of investors from local currency debt markets, but a considerable widening in Eurobond spreads. We know about the policy reaction. We know that the COVID shock was followed by an unprecedented amount of global central bank tightening, balance sheet expansion on a scale we just hadn't seen before. This, in part, is responsible for some of the inflation story today. But at the time, even that unprecedented pumping of liquidity into the world economy did very little for African markets. There's a lot of debate around the debt service suspension initiative, soon followed by the G20 Common Framework for the restructuring of external debt. And the belief was that creditors to different sub-Saharan African sovereigns might be forced to share the burden of some of that debt service suspension as well. So it took a while before we saw any meaningful spread compression in African euro bonds. But even when it did happen, we were very quickly seeing the replacement of one shock, the COVID shock, with yet another, the Russia invasion of Ukraine, elevated inflation, even more concern that central banks were behind the curve and that they needed to do so much more to tighten even faster. All of this has meant very difficult market access conditions for sub-Saharan African sovereigns. The irony of it is that in a slowing global environment where there are concerns about developed market growth in particular, these elevated spreads mean that it's still very difficult for African sovereigns to seek the external financing that they need. often when it comes to the refinancing of existing Eurobond commitments, it's just prohibitively expensive. It isn't going to be happening in the near term. And the longer that situation lasts, where essentially the whole world's economy is having to adjust to the magnitude of tightening that we've just seen, the more the fears about some countries just not making it through this stress are going to be sustained. And there will be investor concerns around who might be next to sign up for a debt restructuring, which is the next country that is likely to default on its debt. Those fears are currently reflected in market pricing, in the elevated spreads, and it's not clear what kind of a situation moves us out of this very easily. So if I were to summarize, if we were to look at the performance of both African FX rates, some of which show the adjustment, even worse cases that don't, where an adjustment is still very necessary, if we were to look at the performance of African Euro bonds, they all speak to considerable financing stresses still. These are the challenges that the Africa region, with all of its natural growth advantages, let's not forget the big picture, demographics that are favorable, an urbanization pace, the formalization of economies, things that would normally lend themselves to productivity gains and faster growth. They're still there in the background, but they're very much overshadowed by these other concerns right now. If we can move on to the next slide, please. And this shows us the impact of offshore investor positioning in local currency markets. Now, to those of you in South Africa, you would know this very well. Around the time of the COVID shock, South Africa also got a downgrade from Moody's that meant the loss of its last remaining investment grade rating. And that meant World Government Bond Index exclusion, the outflow of billions of dollars from the local currency debt market. It's little comfort to look at a slide like this and to realize that South Africa shouldn't be seen in exclusion. If anything, it's one of the economies where there haven't been problems with an FX market that just ceases to be functional, and South Africa has since seen inflows from offshore investors. But for a lot of the rest of the region, with the exception perhaps of Uganda, which is still seen as tradable, which is still seen as open to foreign portfolio investment, we have seen a real step decline in the amount of foreign portfolio investor participation in local currency debt markets. And you can see that despite everything that South African markets have had to contend with, South Africa possibly still sees the healthiest amount of foreign investor participation compared to the frontier market equivalents in the region, where foreign investor interest is really rather minimal, where investor positioning has lightened up very considerably. Now, as always, at the accusation of being an economist who looks at this in many different ways, there are different ways that you can look at this. The good news is that investor positioning is so light that there are very few instances where we think we could be seeing more market volatility because investors have anything to sell, have anything with which they can exit. In a lot of instances, should risk conditions improve eventually, it won't happen until developed market growth concerns have disappeared, and that may not be on the horizon for a long while yet. But should risk conditions improve, because investor positioning in the region's local currency markets is already so light, one way of looking at this would be it can only get better from here on, surely. Or maybe not. Let's move on to the next slide in this presentation. And that slide, very soberingly, shows you the trajectory of credit ratings in the region. We're looking specifically at Moody's here, but it wouldn't be an altogether different picture if we were to consider Fitch or S&P. There is one overwhelming trend that really stands out, and that is that in recent months, in recent years, it's the credit rating downgrades that have become that much more prevalent in the region. Forget the good long-term growth potential offered by African economies. at a time of global stress, at a time of significantly tighter global financing conditions. Most credit ratings have only been moving in one direction, and that is down very considerably. You can see that some economies seem to have bucked the trend, or rather have weathered the storm a little bit better than their counterparts elsewhere. The Francophone economies, where because they have a peg to the euro, they haven't been subject to the FX depreciation stresses that feed into even more concerns around solvency. How will these economies afford to finance their external debt, to pay their external debt service? But by and large, just about every other economy has been subject to a reassessment of credit strength by the rating agencies. There have been downgrades, and in some instances, multi-notch downgrades. I would say we're not out of this process yet. There is necessarily going to be an adjustment to the resetting higher of global interest rates. After the global financial crisis, we had been in a world of such easy monetary policy for so long. Now we're coming out of it. One of the ways in which Fed tightening works is that it causes a slowdown in the rest of the world as well. And that weakening of demand weakens commodity prices, weakens global demand, leads to a lessening of inflationary pressure on a global scale over time. But it's very painful for the weaker credits involved in this process. It's very painful for the most vulnerable economies who are left without the financing that they would otherwise need. Moving on to the next slide then, please. And this is where the crux of the concern really comes about. In country after country, on an almost daily basis, we are asked which is the next country that is going to have difficulty financing its external obligations. One way of looking at this, as we've done here, is to use the Eurobond debt maturities as a proxy. It's an imperfect proxy. The best way to do this would be to look at all external financing obligations, the entire external financing requirement. What do countries need to finance their current account deficits? What debt service do they have to pay over the next year? And that could be principal repayments, it could be the interest payments on the existing debt. Add that all together to get the total external financing requirement, compare it to where their foreign exchange reserves are, and you will be a lot more worried than the simple color scale adopted on this particular table. Even this paints a sobering picture. There are some economies, given their current foreign exchange reserves, that are going to have great difficulty financing their external obligations. At the time when a lot of the Eurobond debt was being taken on in the region, the easy assumption in that instance was that African economies were benefiting from accommodative global monetary policy. This is why they could issue big in international capital markets. This is why they could borrow more commercially on an unprecedented scale. We were kind of worried about what would happen 10 years on, where suddenly the region would see this concentration of maturities. But never in our wildest imagination did we think that this would happen in the context of multiple global shocks. COVID, Russia, Ukraine, an unprecedented speed to developed market tightening, emerging markets having to tighten to keep up. So no amount of tightening is quite sufficient in an environment when all central banks are doing the same thing. And this is a problem because it's suddenly so much more expensive to refinance those external debt obligations. And this theme of which countries are going to get through this easily and which countries will stumble and fall over and may have to sit down with their creditors and try to go through an orderly debt restructuring, it's not going to go away anytime soon. The problem is, given the global tightening that we have experienced, it's going to be very difficult for many African sovereigns to seek the financing that they need through markets. Yes, the IMF and the World Bank and other multilaterals are trying to step up. The global community is coming together to say, what financing can we provide to these very vulnerable economies in a situation where the market financing just isn't available because of the amount of risk aversion out there? But we know from the experience of recent decades, not even recent years, that the financing requirements are substantially more than is likely to be easily satisfied by IMF World Bank financing alone, by what we can get from the international financial institutions. And this is the basic problem. To be able to power African growth, for investment in the region to come back in a strong way, we need to see private sector flows being reestablished. But global conditions right now, the downside risks to growth, the geopolitical fragmentation, the tensions between China and the rest, these are not going to go away. And these conditions do not necessarily lend themselves to the easy availability of financing. So this is the basic problem. If I were to summarize, I'd say I remain, as always, a longer term believer in African growth. We have so much potential. We know from the good years of the kind of growth rates that can be achieved. There is economic diversification to happen. The Africa Continental Free Trade Agreement will set about the impetus for far deeper intra-regional growth. We know that there's still the financing of infrastructure to be able to enhance that process. We know that there are other building blocks to growth. We know that African economies continue to formalize, that there's a lot of upside to revenue mobilization still. That as people move from lower value added activities in rural areas to higher value added activities in urban areas, that there is a productivity boost to growth underway. We know that with the adoption of new technology, we could supercharge that growth in Africa. But the sobering fact is, these are going to be difficult years. Notwithstanding those natural growth advantages, there is the tightness of external financing conditions to contend with. The global community, if it puts any value on the boost to global growth that we could see from an Africa that is performing, needs to come together in a way that is much better than has been done so far to try to deal in a more rapid way with debt restructurings, to try to deal in a more conducive way with the conditions that will attract private capital back to the region. It will happen, but there's a bumpy road ahead as we navigate through these difficult times. So I hope that does as a summary of the overall Africa outlook. We know that we could look at the individual growth outlooks for many different economies. There are different challenges underway. The good news is that in a big economy like Nigeria, which I'm sure you'll hear about, there is the expectation of significant reform impetus. FX reforms, fuel subsidy reforms, things that make it easier to do business in Nigeria. This could be a big boost to overall growth prospects. In other countries like Kenya, where the government is going through a difficult time with fiscal consolidation, nonetheless, we are seeing a willingness to put in place reforms, raising revenue mobilization, ensuring that the process of formalizing the informal economy continues, and this will ultimately strengthen performance over the long term. Let's not downplay the impact of intra-regional trade at all. In a world of global geopolitical fragmentation, when many different countries are moving into different blocks, African countries coming together can provide an important impetus to growth. It isn't going to be easy, but it can be done. Thank you for your time today.
And thank you, Razia Khan, for that presentation. Great and comprehensive review of what's happening in our region. Razia did wrap up by referencing Nigeria, and it's quite great because it segues well into the next conversation. It'll be focused on Nigeria as a market. Now, as we all know, Nigeria is both the most populous country in Africa and also the largest African economy. It has numerous latent growth opportunities. It does face elevated inflation, though, and a depreciating currency, and these have pressurized consumers' disposable incomes and the cost of doing business over there. Limited foreign exchange availability does make it difficult for multinational companies like the MTN Group to repatriate earnings, and this has been a big topic in much of the discussion on Nigeria. We are quite honored this afternoon to have with us today the best people equipped to speak with authority on what's happening in Nigeria. Let me introduce you to our first speaker. He is the Managing Director and CEO of Financial Derivatives Company in Lagos. He's a macroeconomic research and finance advisory firm that he runs there. He's got over 40 years experience as an economist, a banker, and a financial analyst. Ladies and gentlemen, please put your hands together for Mr. Bismarck Rewane.
Good afternoon, ladies and gentlemen. Once again, thank you for having me. And after listening to Razia, I'm encouraged by what I want to say because it kind of validates most of the points I made. But let me start off by saying clearly, the question is, Nigeria is now almost fully integrated with the global economy, 1. 2, there are 3 possible options for Nigeria. We just had an election, and it's being contested in the courts. Is Nigeria at the point of, at the precipice? 1. 2, is Nigeria about to, how would I put it? Nigeria is at the point of inflection, which means it's going to take off, or Nigeria is going to remain the same. Some facts that must be noted. Nigeria's economy is $500 billion. It's about almost 21% of the African economy. 2, the gap between Nigeria and the rest of the regional economy has actually narrowed. 3, Nigeria has actually shifted more from being oil dependent in terms of activity to becoming more service-oriented. I think that is clear. Now the question is, what kind of leadership is going to take place? What kind of leadership and what kind of policy reform, policy change is going to take place? 2, will there be courage and the confidence to have institutional reform, to reform the institutions? And 3, is this change sustainable? And what does the future hold for those who are investing in this country? So let me start off first and foremost by saying, as you can see from these slides, it is during war that generals are made, and one general handing over to a civilian general. The baton change, policy change, and institutional reforms are imminent. Now, we're going to be talking about snapshot analysis and key takeaways. Where is Nigeria right now? Where are the challenges and major policy changes that will take place? The outlook and the opportunities, the risk footprints, summary and conclusion. So firstly, there are about 13 variables that we're looking at here. Of these 13 variables, 3 are green, which is positive, and the others are all negative. But they're looking at the 5-year average as well as where it is now and where it will be in the next few years. Now, what are the key takeaways here? The growth is suboptimal, and I think earlier on, our colleague from the South African Reserve Bank talked about potential growth and real growth. You'll find that Nigeria has been growing suboptimally, and total factor productivity, which means the optimal use of capital, has not been the highest. There's been low labor productivity and underutilization of capital stock. Inflation is at a 17-year high at 22.2%, and it has stayed that way. Again, anchoring inflation on the expectations. Inflation expectations in Nigeria are relatively very, very, people are expecting inflation to continue. So the expectations are different in the sense that the inflation psychology, people have factored in the fact that there will be shortages and the transmission of prices So in future, it's going to be much higher. There is also what we call the lags, the time between when you notice a policy and when you react to it and when the impact is felt. The lags in Nigeria are pretty high. And we'll come back to this because under the new dispensation, under Bola Tinubu, the lags are going to be much shorter because there'll be some decisiveness. Then the monetary policy transmission mechanism is weak. The effective exchange interest rates and nominal interest rates are quite diverse. Now, you can see from that point here that the Treasury bill, 364-day Treasury bill rate is 8%, which gives you a negative yield of 14%. Now, there are also restrictions, forex restrictions and rationing. So you have that whole philosophy that the more you ration, the more you stabilize the price and the exchange rate, but that has not turned out to be true. There are subsidies in the system. Subsidies range from petroleum subsidies all the way to forex subsidies, to fertilizer subsidies, and so on. And we'll talk about the big ones coming up soon. The other thing, we've seen revenues actually begin to decline compared to GDP. So having said that, this is another slide that is important. There's a country of bottlenecks. Here there's a lot of output and a lot of resources, but because of the bottleneck, you will find out you will have negative outcomes. So for example, there's a lot of farmland, 70 million hectares of land, but there's food insecurity because of the bottlenecks. Large oil reserves and gas reserves, but there's very little refined products, and you have the crisis that is at hand right now. There's a large population, but low productivity. There's abundant water resources, but low irrigation and poor electricity. There's a high volume of fertilizer, but you're also having low agricultural output. Having said that, what will the new administration and major policy changes? So, what's the background of this guy? This guy has worked at Mobil, and he knows how to pick the right team. He has big dreams, and he has a lot of good ideas, but he has skin in the game. In other words, the value at risk, if anything goes bad, he has as much to lose. In fact, he has more to lose than the ordinary man on the street. So he's got big dreams, but dreams can become nightmares if you're not careful. But also, but you have to start by visioning and dreaming, and then you set your goals, and then you have the outcomes. So what has he said? He said, I will remove petroleum subsidy, and that he did yesterday. And then, of course, there was a crisis, and it's moved in, and they fixed the new prices. So things will get better. He talked about unified exchange rate, which means that, again, he wants to deal with the subsidies. Repatriation of profits for investors, both domestic and international. That was there. Multiple taxes, he wants to reduce that. Then it talks about institutional reform. How will you house cleansing at the central bank, low interest rate and business loans, infrastructure development, and so on. So, but again, there are too many things, too many problems, and he has to prioritize, and we are going to have to speculate. This is what you're seeing. Announced the policy removal, the outcome was what you saw here, but all of a sudden today, we've had a new pricing regime, and the problem seems to be at least going away, and he's dealing with it. Now, the negative effect, is there the risk of a policy backlash? We've seen that, but again, because he is decisive and he has a maximum of 90 days of honeymoon, because don't forget there are the trials going on, the petitions and the tribunals and all that. So if he does well, and people now say, okay, sure, why bother yourself? There's no need. Second, one, why do you have to remove him? Two, if he's to go back for a rerun, because he has actually set the stage and people have seen the performance, he's more likely to win, like what you have in Turkey. So that's one of the things you have to look at. So there's no political honeymoon as such. He has only 60, 90 days to do, and he has to deal with it very quickly. And if there's anybody that can do it, he could, just like any of the others. But because he has more skin in the game, he's more likely to want to make sure that he wins. Could there be a disruption to economic activity? Yes, we've seen that, but there's disruption fatigue in Nigeria right now. And so people just want to get things going. How would the reforms look like? we've done some dimensioning. The official exchange rate today is 462. It tested 632 and has been back and forth. We think in a post-reform environment, the unified exchange rate will be at about 600, whilst at the same time, the parallel will have about 3 to 5% differential, maybe about 650. Petrol price 185. Today it's trading at about 530. And what does that mean? It means that the inducement or the incentive to smuggle across the border, across to African other countries, is reduced. So you are reducing essentially the amount of subsidies in the system. Another thing that I want us to think about is the price of energy. Today it's about 72 naira per kilowatt hour. We think that it could go to about 90 to 95 naira per kilowatt hour. Strangely enough, the total effect of that is that people will get more quality power and more reliable power, and actually the Nigerian consumers will benefit more from that adjustment than what you see. So this is where we see exchange rate convergence and unification, and it's possible, depending on the fact that if you ensure that the supply of the foreign exchange is there. I saw Razia's slides here, and she talked about external reserves. The external reserves, Nigeria has gross external reserves. All the other reserves are net external reserves. So we will have to know exactly what the true position is. But I think there's enough to actually support the currency if you allow it to be priced properly. So what does this all mean? It means that today, this is what the GDP, what we call the circular flow of income. So of the $508 billion, $350 billion is actually aggregate consumption. If you remove the subsidies today, the private man on the street is going to be losing $26 billion. And the currency adjustment will also give him back about $4 billion. The investors are going to be bringing in, because of currency adjustments and all of that, they will get about $9.5 billion increase in value. And government is, of course, going to benefit significantly, because from petrol subsidy removal, the government will get $10 billion, and from currency adjustment, the government will also get some more. Net exports also is positive. So generally speaking, the effect on the economy is positive. But the change has to be there, the change has to be sustained, and the change has to be continued. So these are just things that, how will it impact on the telcos and fintechs and PSBs? Yes, because of subsidy removal, again, because consumers have less money to spend, it depends on the price inelasticity. So once I pay more for petrol, then I will have less to pay for data, to pay for food, pay for, it depends on the relative inelasticity. So people are going to have to make that, what we call income adjustment and substitution adjustment for what you consume. Now, unification of exchange rates means that, generally speaking, if the guys today are spending 765 effectively, and it goes to about 630, then net, they'll be getting more money in their pockets. The same thing will happen for power. So at the end of the day, you'll find that the Nigerian consumer probably has more to gain from the reform, and the Nigerian investor and provider of resources like telcos and fintechs will gain more from the post-adjustment environment. So long-term gains, like I said, government revenue increases, foreign investment increases, and the diesel price, which is a proxy for a deregulated price of petroleum, is at 620. So that's where, and this price had gone all the way to 850 naira in the past 6 months ago. So if that happens, you'll find that net, you'll find that you're spending less on diesel, and that's good for the telcos because of the capex and everything they have. What's the outlook and the opportunities? Short-term outlook, GDP growth will slow to 2.9, which is not bad compared to where the other African countries are. Inflation will climb to about 20.3 in 2023, and then it begins to slow down eventually because output increases. The official exchange rate will merge at about 630. Initially, because of fear, it will go all the way to 680 and then begins to go down. One thing that is clear is that between yesterday and in the last 2 days, we've seen the stock market appreciate by about almost 5 to 7% in some stocks, and the leading stocks. So that means if the stock market is a an efficient reflection of future expectations, that means that they've actually factored in the fact that these reforms are here to stay and they will benefit everybody. So what are the big game-changing things? The African Continental Free Trade Agreement means economies of scale, intra-African trade will actually increase, and that's a major thing to look at. The Lekki Deep Sea Port and the Dangote refinery and petrochemical plant will do a lot of things, but it's a necessary condition but not sufficient to solve all the problems. Because what happens is that we take crude out for refining in Rotterdam and bring it back. So the changes are not that significant in terms of forex, but it helps in terms of reducing downtime. So it's not a silver bullet, but again, there's the petrochemical part of it, there's the fertilizer part of it, and then there's the refining part of it. But again, the Dangote refinery becomes a hub refinery for the whole of West and Central Africa. I think that's worth noting. What do we see for financial inclusion and opportunities here? We've seen that there's a lot of the payment and settlement system has increased in terms of has become more efficient. And just like in Kenya, starting in 2007, and other African countries, we are beginning to see that correlation. So we are now beginning to see the effect of this payment and settlement revolution that is taking place in Nigeria and we like the rest of Africa. The other thing you must note is that the 5G networks, there's a lot of investment in CapEx that will, and the float of funds that will, let me take it in bits. That is one, there's a lot of investment in CapEx. There's the reduction in, there will be an improvement in power supply, reduction in the price of diesel, and therefore the benefits for financial inclusion and an improved payment and settlement system and the increase in the velocity of circulation of money means that Nigeria begins to benefit from the scale economies and settlement of its transactions. And that shift from brick and mortar to virtual payment systems and all that means a lot. Now, what kind of reform do we see in terms of institutions? The institutions that will be reformed are about 5 or 8 of them, but the key ones, federal inland revenue will be number 1, number 2 will be NNPC, number 3 will be the central bank, number 4 will be NCC. So we think that there will be limited regulatory trespass. In other words, NCC will regulate the telcos, the central bank will regulate the financial institutions, and therefore, and then the rates of interest, there are 2 major benefits to the PSBs. One is that they can charge efficiently and reap from the benefits of the investment in CapEx. 2 is that the float of funds that come to them under the financial inclusion and the mobile payment system has to be invested so that they can get a decent return. So when you take the charges, 1, the increased activity, and 3, the yield. The yield on it's a win-win for the telcos in that area. And because of the regulatory reform and institutional reform and the segregation of duties between the NCC, central bank, and others, I think it's a much more efficient system. So we think the NCC becomes more powerful. The central bank will go back to more orthodox monetary policies. There'll be a more efficient payment system, and high income from fees charged, and the activities will increase. So that's the good news. This is the projection of mobile subscribers and broadband penetration. We're going to see more of that, and there's a lot of investment in this. And Nigeria, because of the new leadership, and no matter what happens in the tribunals, we are going to be seeing the benefits of this. So in summary, I think that 1, GDP growth will follow this trajectory and begin to improve as we go along. 2, Nigeria will not slip into a recession. The macroeconomic problems are well documented. Slow growth, high inflation, weak public finance, but the reforms are going to address this quite aggressively. Exchange rate unification will benefit everybody, including the government, the people, and businesses. Policy reforms will come with short-term pains, but those short-term pains will be pale compared to the gains that are going to come. Telco providers will benefit in the long run. I think there'll be reciprocity, there'll be connectivity, and there will be, those are the 2 key things, reciprocity connectivity, and also the fact that Nigeria will benefit from a showcase of companies that are in that sector will benefit. Ease in forex sourcing challenges, and the fact that we think that over the next 3 to 5 years, Nigeria will head towards currency convertibility, and therefore, the whole idea of moving money around, fungible funds, going from one market to the other, the ease of doing business across the West African region will become extremely beneficial to investors. The Dangote refinery will help in terms of creating scale economies, but there's a big risk of, one, the obsolescence of oil over the long term, the shift to renewable energy, and also the growing irrelevance of OPEC over time. These are some challenges, but in the meantime, in the next 3 to 5 years, you are going to be seeing the benefits of what I've explained. So GDP will slow in that lull and drop in disposable income of people will not be as impactful, negatively impactful as we thought. The minimum wage in Nigeria is 30,000 naira, and that was decided about 4 years ago. We are in for the new round, and that will happen. So you're going to have some wage adjustments to come. The monetary policy rate is about almost will peak at about 19.5, begin to go down. Official exchange rate will go to about 600 naira, which is a major shift. And then we, at worst, we'll see ourselves coming to about 650 at a unified rate. Power market rate is appreciated towards 680 initially, but then we'll see some struggling there. But in the end, the availability of foreign exchange will boost trade, and trade is the most vibrant sector of the Nigerian economy. Don't forget the Nigerian economy has an informal segment. So while you have $508 billion as a formal economy, there's a 30% informal economy, and that activity level there changes things almost dramatically. And finally, as far as the West African region is concerned, Nigeria continues to dominate that region, both from an informal trade perspective, from a formal trader's perspective, from the export of cement, petrochemicals, fertilizers, and the refinery hub. So there are some good signs to come, but there are some risks that are there. The Turkeys don't vote for Christmas, so the guys who have special interests, who have vested interests, are going to push back. But I think that the guys in charge now have been part of the vested interest, and they know what it is. It takes a vested interest man to catch a vested interest man. Thank you very much.
Oh, it takes a vested interest man to catch a vested interest man. Mr. Rawane, please join me on stage and grab a seat. And I'd also like to call the CEO of MTN Nigeria. He's been steering the ship there for a long, long time, in this role since 2021, but has been with MTN Nigeria since 2006. Of course, I'm talking about Mr. Carl Doriola. And the two of them and myself are going to take some questions from you. If you are dialing in on the webcast, please share your questions on the Q&A panel that's below your screen. And of course, for everybody in the room, please just raise your hands, and the roving mics will get to you as soon as possible. Mr. Rawane, let me start with you and talk about this vested interest man. You know, a lot of people, a lot of analysts and a lot of role players, especially when it comes to our continent, there's a big kind of indexation to politics. Just because, you know, generally as Africans, we seem to have not always gotten the political side of things, you know, the best of ways. And every time there's a new president, there's almost like this new hope. And you were quite sober in your analysis. There were some very positive things you said, and you had some warnings. And I'm keen to hear your personal views of what do you think becomes the Nigeria post these elections. Inflation doesn't seem to be abating. There's lots of talk about President Tinubu's cabinet and his choices of the people he will govern with. You've already said he's a man who knows how to pick a good team. But outside of the presentation, what are your thoughts?
Well, I think the presentation actually captures it. I'm being brutally frank. The truth is that I think it takes a vested interest man to know how to capture it. That's first. Secondly, he has a lot more to lose, both personally and from a reputational perspective than any other person.
Well, why is that?
Because he has investments, right? He has a lot of investments on the ground. And during the NSAS riots, he was a victim of, he knows what the people backlash could mean. So the best, not to crush it, but to prevent it from happening. The only way to prevent it from happening is to ensure, one, that institutions are reformed and that policies actually give you the positive outcomes. The value at risk for Tinubu or any of the other candidates for that matter is much higher than the value at risk for the guys who are just vested interest out there. Because you now have political risk and you have economic risk and he has personal capital risk in all cases. So it's a no-brainer. The truth is that nobody benefits from a crisis situation. And the best people to prevent the crisis are those who can read it and can react. There's no lead or lag time.
Got you. You mentioned the point about his planned reforms on the repatriation of profits. That's been a big topic over the years for the MTN group and widely covered by many of the people in this room. Do you think these reforms are going to work? And if so, why?
Let me tell you why. The thing is that if you look at Nigeria's balance of payments, you have a line that is visible tradables, where you sell oil, cocoa, cashew, and others. Then you have the invisible flows, which are diaspora flows that are coming from Nigerians outside. Then you have invisible flows from musicians, the entertainment. So if you look at the trend, you'll find that that part that comes from oil and gas is reducing relative to the invisible flows. And the reason why the invisible flows have not been reflecting is because of the rationing and the dangerous policies of stopping all the exchange rate controls. Once you lift those controls, those flows will come in and Nigeria will have enough to meet those repatriation things. And I think the MTN Group and other investors will have no fears about the fact that if I bring my money in, I'll be able to get my money out, right? Rather than just having all those restrictions. But you see, the restrictions are part of the institutional decadence that have taken place. So you would have to not only change the people, because that's not, you can change the people from now to tomorrow, it won't change anything. You must reform the institutions. And like I said earlier in this discussion, the mental adjustment is much more difficult than the fiscal adjustment, the financial adjustment.
All right. Carl, if the way MTN Nigeria has been covered by analysts over, let's call it decade, maybe decade and a half, I would summarize it as, the investment community has a love and hate relationship with MTN Nigeria. When it pumps, it really pumps and everybody loves it. But every once in a while, there's like a little, screwdriver that goes into the works and everybody goes, oh no, now what's going to happen at MTN Nigeria? When you hear about these reforms that have been quite well articulated by Mr. Rewane, what do you think of the current situation and how does that, for you, work out in terms of the opportunities that lie ahead?
Yeah, well, thanks, and it's great to be here with this community. I think perhaps we've been unfairly characterized by two large instances or incidences. One is the fine, and the second is the whole noise about the currency repatriation, and both have been firmly put to bed quite a number of years ago. And we've consistently delivered positive results, and by the way, also repatriated proceeds to MTN Group over the period. But the worries over the macro, the flows of capital, etc., are valid and have been valid in spite of our successes in the past few years. I personally am very excited. I think most Nigerians have been optimistic that the next 8 years must be better than the last 8 years. And if you want to write a script on how to start your first day, your inauguration, your first few days of political leadership, in Nigeria, I don't think it could have gone better than it has in the last 2 or 3 days. Now, let's be clear, that's 3 days in a span of 8 years. A heck of a long time to go. But announcing clearly that the subsidy is gone, then following it up by an immediate price adjustment, and today in Abuja, the capital city, in the NNPC petrol station, the mega station in the capital city, the prices have been adjusted of petrol. So that is a demonstration of a follow-through and decisiveness in policy implementation and in recognition that the difficult decisions need to be taken. So I'm optimistic. I'm actually quite excited as a Nigerian, first and foremost, but of course as the leader of the great subsidiary of MTN Group, that the outlook is good. I think Bismarck has been spot on a lot of the points. The intellectual capability of President Bola Tinubu, his private sector background, his ability to put together, and he has a proven track record of that, a great set of technocrats. And then this first few days of quite firm decisiveness in tackling probably what is politically the most challenging policy decision that he has to take. So quite positive on that.
What does that mean for some specific opportunities for you? Because, I mean, this doesn't come, this comes in the context of you already launching new products and trying to grow subscribers and trying to grow your digital offering. If all things work out as you both hope, as you've articulated, what do you think that looks like for the actual MTN Nigeria business?
I think we've established ourselves as a critical part of the economy, and you can see that from the contribution of telecommunications to the GDP numbers, and in the ambitions of the digitization of the economy. An improved ease of doing business, more transparent, predictable government allows us to do a few things. One, continue down our path of accelerating digitization of the economy, not just in the core telco space, but particularly in the fintech and PSP space, to increase the velocity of cash and transactions in this space. So it gives us predictability and an optimism around continuing to execute our plan, which has firmly been in place, Ambition 2025, but even possibly accelerate that. We've managed our capital allocation very cautiously and according to what we've committed to the market. But we've never missed an opportunity to accelerate as we see increasing demand, sustained changes in things like the demand of data consumption. And as we're seeing now and then pushing forward our opportunity around the PSP, we'll capture those opportunities with a much more stable, predictable, and consistent policy framework from the federal government that allows us to get even more aggressive in those spaces.
Sounds great. All right, I'm going to open to the room. Ladies and gents, any questions for the Nigeria team? We've got the person who runs the business there, as well as a very, very articulate and clear analyst of the matters that are going on there. Any questions in the room? Going once. There's a hand right there, my lady. Thank you.
Thank you for that optimistic outlook on Nigeria. Maybe you can just give us a view on when you think we will start seeing changes in the central bank space. And what do you think, I mean, do you think that'll happen before or after the unification of the exchange rate? Thanks.
Great question.
I think there are two different things. The unification of exchange rates is a process. And our view is that over the next 3 to 5 years, you will have full convertibility, whether we like it or not, right? Two, that the central bank policies, which has gone into, unorthodox policies, lender of first resort, those things have virtually come to a halt. Now, the reform that is required to make it more accountable, because, for example, the central bank has not published its audited accounts for some time. So all those things are now going to be done efficiently, but it's only one institution. There are many other institutions that need to be reformed. But once the leadership is clear that this is what I want to do, I will not tolerate that, you'll find those institutions become reformed almost automatically. And what does this mean for institutions like MTN when I said productivity? One, Nigeria needs productivity. Two, connectivity, right? And then reciprocity. In other words, invest and you get, as a postal investor in this country who has gone through the thick and thin, it becomes, so there's an alignment of goals and views, both from MTN and other telcos, and in Nigeria, the new Nigeria. Now, there's a point that Razia made about maturing obligations. I think there's a 500 billion euro or dollar obligation that is due soon, and there's the whole question of downgrades. And so Nigeria needs to, one, sort out itself with the IMF and the Washington Consensus, also go to the other creditors, and three, deal with the Paris Club at the same time. I think these things are possible because of the the clear signals that are coming out. That one, there's decisiveness. Two, there's value at risk. And three, that investors will have actually showing some signs of confidence by coming back and investing. And if you look at the $508 billion could easily become $700, $800 billion if everything is captured and is well done. Multiplicity of taxes reduced. So I wouldn't say there's any sequence of changing people before reform. I think all of them go together.
All right. Should we take one more? Yeah, sure. Follow up.
Just
I
a
didn't catch
follow-up.
your name, by the way, or the organization.
Sorry, it's Pallavi from Coronation.
Thanks.
One more follow-up maybe, then just a comment on the outlook for taxation, because you mentioned the fiscal pressures. So maybe if you could just comment on overall taxes. Thank you.
I think first and foremost, taxes, there are 4 canons of taxes. There are taxes. 1, it must be neutral. 2, it must be progressive. 3, it must be equitable. And 4, it must be easy to administer. Now, going by those canons, Nigeria will rely more on indirect taxes, or what we call benefit approach, rather than ability to pay approach. So you are going to have a VAT increase, I think, from last time VAT was 5%, we moved it to 7.5%. Now we're talking about going to 15%. I don't think that will fly. You are going to have it go from 7.5% to 10%, 1. The excise duty on telco and things will be a big struggle because that has a major impact. But I think there will be somewhere in between. The corporate income tax rates remain about the same. There are sales taxes and all sorts of taxes. But one is to increase the tax efficiency and reduce the burden, right? Secondly is, what do you use the tax revenue collected to do? The people must see the impact. So the most important thing is there's a trust deficit and credibility gap. My approach will be give the people the benefit of it before you even take it away from them. Right now, we've taken it away from them, right? And people are beginning to wonder, okay, what are they going to use the money for? But if you are actually giving the money to the people by shifting and then collecting it later on, then you will have addressed, 1, the credibility, trust deficit problem. 2, it will give you a lead time, and then you can actually borrow against it, like revenue anticipation bonds and all that. So again, it depends on how Tinubu wants to look at the sequence of what he wants to do and how you're going to have to manage the crisis of false expectations, which I think is used to that. So again, it takes vested interest to capture vested interest.
That's going to be trending all afternoon. Yes, Scott.
Point. I think Bismarck is spot on. They will use some levers to increase the overall tax income, things like VAT, although that's probably a few months away. However, if you look at the antecedents of Bola Tinubu, he's been very effective in Lagos State in generating internal revenue by expanding the tax base. And there's been engagements across people who are speculated to be in his economic team, and they're very clear that that's a priority of theirs. So rather than just going to the automatic obvious sources, which there will always be a little bit of in every country and every economy, there's going to be a lot of focus in developing the tax base itself on a larger scale to sustain the policies and the fiscus of the country.
Interesting. I'm going to wrap with one last question for you, Bismarck. The first part of it you've already answered. It comes from Madhvendra Singh. He's from HSBC. The first part was about the impact of the launch of the Dangote refinery on the economy, Forex and the fiscal outlook. I think you've covered that quite in depth. But the second part might be quite interesting to hear your views on. Can Nigeria take credible steps to reduce import dependency for non-energy products as well?
I think, as an economist, I tell you once price changes, the quantity demanded will change. So what is the price of imports? The price of imports depends on the exchange rate. There's no better way of diversifying the economy and dealing with import dependence there's no other credible way than to allow the exchange rate to find its true value. Once you do that, you find what happens. For example, Take medical tourism. Because it had become more expensive to get forex and travel abroad, we've seen a massive level of investment in medical substituted medical services within Nigeria, i.e. Evercare, Evergrade, Eurocare, and all of that. We've seen schools like the Waterman and others because of education tourism. So if you allow the exchange rate to become really driven by the market, you find automatically, and you will find that happen, right? You don't have to have a special task force forcing people to, the old mundane, what we call the infant industry argument. You nurture people until they get to a particular point. No, those things are far gone. I believe that the policies, the institutional reform, the mental adjustment, and the fact that you are at the mercy of your consumers, one, and creditors, two, right? And more than anything else, the political transparency that is required under the new electoral processes makes it almost impossible for you to, one, run an inefficient government, run an indolent government, and being totally indifferent of the views of the people. I think that's my...
Wow. What an interesting insight. Ladies and gentlemen, we're going to have to wrap it there. Thank you so much, and please give a round of applause for Bismarck Riwane and Carl Toriola. Thank you, gentlemen. What happened there? All right. Hey, who's this guy? Ladies and gentlemen, introducing Sporty. If you didn't get a chance to see him, there's actually a very interesting story about this robot from Boston Dynamics, and thanks to the power of 5G. I'm told that this guy is currently working in a mine here in South Africa, and he's been able to go to the parts of the mines where human beings cannot go because it's so dangerous. And of course, the mining industry is focused on ensuring that there are no fatalities. But anyway, the 5G network helps this guy be able to track all sorts of things and be able to be used in very dangerous circumstances, doing his thing, as he currently is on stage. And apparently his name is Sporty. If you come from South Africa, all dogs are Sporty. Let's give a round of applause for that. Oh, that's very interesting indeed. Thank you very much to Mr. Riwane. Thank you very much to Carl. And thank you very much to Sporty, who needs to find his way. Wow, how does it do that? Just got off the stage, didn't fall at all, unlike most of us. Okay, cheers, brother. Oh, wow, that's really cool. Oh, that's interesting. All right, thank you very much, ladies and gentlemen. We're going to take a bit of a stretch break right now, just for about 10 minutes or so, in case you need to get some coffees or waters. You can also just chill in your seats and answer some WhatsApps and emails. And in about 10 minutes, we're going to pick up again and go straight into the Ghana market. And we're going to have a very similar insight into that market as well. You might know that it's the oldest market for the Momo product of the MTN group. So I'm pretty sure you'll be interested. It is 15:47. If I could have you back on your seats at, let's make it 4 o'clock, and we'll kick off. 15:55. 15:55. Great stuff. Thank you. Welcome back, ladies and gentlemen. And we're on to our last stretch for day one. And of course, later on, as I promised you, we do have dinner arranged and planned. If you used any e-hailing service to get here and you are joining us for dinner, you need not have to arrange that. There is a shuttle that will be waiting as soon as we are done here that will be able to take you through to the venue for tonight's dinner. Right, we've just had a very interesting session about the Nigeria market, and a neighbor of Nigeria is Ghana. We're now going to move on to Ghana, which is home to MTN's oldest Momo market. Ghana is facing significant economic challenges. There's been a sharp increase in inflation and also a well-publicized depreciating currency that has put a lot of pressure on the disposable incomes of consumers and also historically made it difficult for government to repay its debt. However, just 2 weeks ago, Ghana secured a $3 billion loan from the IMF after its creditors agreed to a debt restructuring. It gives me great pleasure to introduce to you the Honorable Minister for Finance and Economic Planning, the Honorable Ken Ofori-Atta. He is in his currently in his second term in this role, and he taught me that in South Africa we speak of ministers of finance. In Ghana, he's the Minister for Finance. So please put your hands together for Honorable Minister of Finance, Economic Planning, Ken Ofori-Atta. Let me also tell you, I think it's quite important that I do this properly, Honorable Minister. Prior to his appointment in this role, he was a co-founder and executive chairman of a leading investment bank called Data Bank Group. Before that, he was an investment banker at Morgan Stanley and Solomon Brothers in New York. And during this illustrious career, the minister has received many numerous accolades for his many contributions at home and abroad. Another round of applause for the Honorable Minister.
Thank you very much indeed, and good afternoon to you all. It's really a great honor to be here, to be part of this, to have been invited by MTN. And as we all know, it's been a very difficult period. As you mentioned, inflation has been high, debt issues, currency issues, and he was really kind not to mention the numbers because inflation went as high as 54%, and we are now at 41%, and we think we are tabling down. The currency last year was also came down maybe 54%. We ended the year at 30% or so, and we are seeing some stability going forward. Debt has been a major issue, and we've gone through some restructuring. This is not a good time to be finance minister anywhere. Minister for Finance anyway. But truly, so this is in effect an outdooring of some sort, and I thank MTN for this. As was mentioned, we just very recently, 2 weeks ago, managed to secure an IMF program, which I guess many people thought was not possible, including we ourselves in Ghana. But it has been done, and we are grateful for it. So for us, we continue to be extremely optimistic. You know, our president was one who declared an Africa beyond aid, a Ghana beyond aid, and we've had these major interventions that brings a certain sense of cynicism and an inability to do it. But we have hope, and we believe that it can be done. So for us in government, we want Ghana to be the best place in Africa to start, grow, and invest in a business. And I hope that through today's interventions, the community will better appreciate how we intend to realize this ambition. Obviously, Ghana's recovery is most important to the citizens who live there. However, it is worth highlighting that recovery is also crucial in the broader context of African development because Ghana has always been a leading light on the continent. From our early independence years through to our embrace of market reforms, and more recently, Accra being the host city for the most extensive trade deal on the continent, the African Continental Free Trade Area. That's 1.3 billion people, $2.5 trillion. Ghana has always been one of the leading candidates to become a unicorn in Sub-Sahara. Our history has though been checkered, and believe it or not, this is our 17th time going to the IMF. Is that the last time? We believe it is. With some, I think we have significant comparative advantages, including just the geography, the size, institutions, human capital, and the history. A can-do spirit, which Nkrumah unleashed on the continent and really has stayed with us as a people through that. So for about 32 million people, our country is large enough to create a substantial domestic market, but small enough that providing jobs and enhancing social mobility is not an impossible challenge for the government. Moreover, Ghana scores well on international indicators of governance, quality, freedom, democracy, ease of doing business, and corruption. Also English, the international language of business, is also our lingua franca. Before the pandemic, our GIPC, led by Mr. Grant, reported that we were ranked first in West Africa based on rule of law, first in West Africa based on ease of doing business index, second in West Africa based on the Global Peace Index. I wonder who could be first in peace in West Africa. It must be us. And projected by Bloomberg in the good old days to be one of the fastest growing economies in the world through 2020 and 2021. So to ensure a deeper understanding of the needs of the private sector and drive the needed economic growth, government is setting up what we call the Ghana Mutual Prosperity Dialogue as an anchor to engage the private sector at the respective industry levels and to ensure sector forward-looking policies to reflect aspirations of industry people. How do we work with industry in a new way, given that the gap between our savings and investment is high, and we need to bridge that, and that will come from foreign investment and also galvanizing domestic savings. So we are willing to listen to the investor community and take the requisite steps to create a more competitive, transparent, and attractive business landscape. So this is how we look like. 2017 to 2019, average 7% growth, fiscal deficit brought, and that was double the 3.4% that we inherited. Inflation actually coming down to 8% and a positive primary balance. Then 2020, 2021, COVID pandemic, as we saw it, the war, financial global tightening, global supply chain disruptions, which led to the red boxes, grave fiscal imbalances, and debt vulnerabilities. I guess many of you who were invested in Ghana, went through these difficult periods in which foreign exchange were problematic, and truly one wondered where we were going to go and where we were going to land. But truly, I cannot find another example in history where so many different headwinds simultaneously hit any economy. And truly, there's a perfect storm that occurred. But with the benefits of hindsight, I can truly raise my hand and say, just like many other African ministers, finance ministers did,
I didn't get everything right in the early days of the COVID-19 pandemic. Indeed, in the immediate aftermath of the pandemic, my colleague, Minister of Finance, Zainab in Nigeria, remarked, no one teaches you how to manage an economy going through a pandemic. But even there, I think we did quite well, like most other countries. We had about 1,470 people dying compared to 250,000 in Africa, and some 1.2 million in the US or so. Even in Korea, they had about 35,000. In effect, the comparable number of people, 50 million, 30 million, would have been about 21,000. So we did spend considerable amounts of money, leading to a deficit of some 25 billion CDs, where revenues came down by 12 billion and expenditures were up by 13 billion. But truly, as our president said, we cannot bring people back to life, but certainly we can revive the economy. And that, therefore, was what we were called to do. So the whole issue then of the kind of debt that we owed, leading to the downgrades and loss of external capital market, and then externalization of capital by investors, led to a heavy reliance on domestic financing, and that continually led to increasing costs, eventually leading to deficit monetization in 2022. Foreign exchange outflows put pressure on the cedi, and sharp depreciation, as I mentioned, as high as 54%, ended the year 30% 2022, but truly exacerbated the debt vulnerabilities that we were experiencing. So all these outcomes culminated in a severe balance of payment challenges and debt vulnerabilities. Government used available fiscal and monetary tools at our disposal to mitigate the impact of these developments, yet the toll from the effects of multiple global shocks cannot be understated. I think we sometimes forget that. As such, to protect all the macro and social policy gains made since 2017, we had to resort to the IMF. And I think I'm famously quoted as saying that we shall never go to the IMF. And we had to go to the IMF. Well, the point after this is to realize that there's a community to be saved, there's a community to cross the Jordan, and it's not really your personal issues, but what is it to do practically to move then to the next level to ensure that we stay alive. So we did go to the fund, and we developed what we call the post-COVID-19 program for economic growth, anchored in these specific areas. So front-loading of fiscal measures to bring public finances back on a sustainable path in an accelerated way, to restore debt sustainability, including the cost of financing, where we're talking about debt at some point becoming more than 100% of GDP, minimize fiscal risk, including risk from contingent liabilities from SOEs, where entities like Cocoa Board and Co. and the energy sector had chalked up some very serious debts that we were not aware of, to deepen the structural reforms and restore investor confidence, and therefore boost development partners' disbursement to unlock other sources of financing, and then to implement reforms necessary to encourage private investment growth and job creation. This really is key, and therefore programs such as this are relevant to us, that we are going to do many more of these. But at the same time, to ensure that you safeguard social protection, so that issues of school feeding to our kids and livelihood empowerment programs were literally doubled to make sure that in these austerity times, those citizens are also protected. So the PCPEC program really it's to ensure that we are moving in a direction of adjustment that will bring us back to stability. So you can see fiscal adjustment efforts of literally 5 percentage points of GDP, ensuring that revenues and expenditures are managed, targeting a primary balance on a commitment basis of 1.5% by 2025, also trying to anchor inflationary expectations and preserving financial stability, adopting the requisite reforms to achieve greater forex flexibility, and then the restoration of public debt sustainability. The goal was really to move towards a 55% debt to GDP ratio by 2028, and also extend our debt servicing to revenue not to exceed 18%. And lastly, of course, enhancing economic competitiveness of exports surpassing 37% of GDP in the medium term, whilst concurrently strengthening the social safety net that I talked about. So key highlights of the fiscal adjustments, revenue and expenditure measures, fiscal adjustments, 2020 really front-loaded 3.1 percentage points this year, and then going through Parliament with a number of revenue measures. That was really difficult. It took a while to get through, and yes, we moved VAT to 15% or so. And that, strangely enough, was able to occur last year, whilst a number of other revenue bills were held up until this year, that we finally got them through, losing about half of the resources that we had anticipated anyway. But I think the country now is moving in tandem. So the PCPEC program looks at public financial management reforms, which are really strong in terms of getting back the state-owned enterprises, especially the energy sector and cocoa board. Energy sector, I'm sure we have a few things to share with our South African friends, where we signed a number of emergency deals, but giving them 10 and 15-year contracts. I don't know how emergency becomes 15 years. And then for them to also have take-or-pay contracts, which were terrible. Financial sector reforms, we came into government and cleaned up about 25 billion CDs worth of that. But through this debt exchange program, we are going to have to put some more resources in supporting the solvency of the banks. Tax policy and revenue administration going to be key for us to go there and change the way in which efficiencies and leakages and corruption that comes in there. And here is where technology again will be helpful, and therefore working with entities like MTN to look at that. So I think MTN needs to redefine its role going forward. And it was interesting for us. We went to Korea. We just came from there. But the integrative nature between governance and the major firms, are key. Whether you're going to follow the Chicago ideologues of, you're just working for the shareholders, or whether you are working for stakeholders. And whether in Hyundai and Samsung and Co., working with government through 1960 to now, they haven't created a much bigger market to support the growth of the firms. So I think it's an existential moment in terms of thinking through what the philosophy of a company, an African multinational, should be with regards to their relationship with governments going forward. Government understanding that they need to give space, and multinationals also stretching, Ghanaian, African multinationals stretching themselves to appreciate that real responsibility to change the fortunes of this continent. So the question also becomes, well, where would you get the money from to be able to do this? And here, the $3 billion facility that we negotiated, and that actually was kind of a stroke of luck or blessings, because we were able to get 3 times our quota, 304% of our quota, which gives us a $3 billion. And we're also able to front load, so that in 2023 we get 1.2 billion, and it was amazing. We got the approval on a Wednesday, May 17th, and by Friday, May 19th, IMF had already sent in our first tranche of $600 million, because we had also fulfilled all the prior actions before then. So the next $600 million will be released, dispersed somewhere in November, and then it becomes 360 going forward to 2026. Then, of course, the World Bank, we have a DPO that we expect of 300 million, and then 250 million that they are going to use to support the Ghana Financial Stability Fund, which will create some resources for the solvency of the banks, and then 300 million going forward in the years ahead. We expect the standard debt restructuring to provide financing of about 2.5 billion. As you know, we are in discussions with the Paris Club, and they gave the financing assurances. An MOU will be completed in the coming weeks or so, and that should be helpful in the way forward. So we also have project loans that we'll be using, and World Bank to disperse another 1.45 billion during this period. But the issue of debt restructuring has been one that has been contentious, very difficult, and really took quite a bit of courage from government to do that. Essentially, therefore, the old bonds, as you can see, 19.1 short maturities of about 4 years, moving that to 9.1%, 8.2 years. Now, that will not make anybody happy, individuals, institutions, everybody. But the reality is that government was not going to be able to support that. And this really is not the first time in history. Even if you look at Korea, they had these things called the curb loans, and they also went quite drastic in being able to cut down that, reduce it, extend the maturities, and basically change the landscape in their economies. So after a lot of difficulties, we were able to get 83 billion of the 98 billion outstanding to participate, which, as you can see, would dramatically reduce the interest payments and give us the appropriate fiscal space to be able to do what we ought to do going forward. Are we done? No, there's still some ways to go. We still have to work with the pension funds, who have about 29 billion, and really to let them know that it's not in their best interest to be in government paper. 70% of their money is in government paper, and we need to change that. We also need to get them to use some of their resources in real investments, like toll roads, airports, etc., housing, urban transportation, which happens around the globe. So there's a new thinking, and we hope that will come to the same place. But we did agree with them that we should find ways to ensure that sustainability and help with macroeconomic stabilization and the economic recovery. Of course, that has been interpreted differently from what we believe to be the spirit of it to what is. But I think we are making headway in those discussions. We also have independent power projects, and I'm sure South Africa would also be beginning to understand this. So through December of last year, it's about 1.6 billion that we owed. I imagine through May, by the time we finish with the discussions, it will be about $2 billion in which we need to find ways of ensuring that going forward, we will be able to pay them regularly, but somehow find a way to restructure this 1.6 billion so that we all look to burden share in where we are as a country. Then the restructuring of external debt. As you know, the Paris Club, fortunately for us, we were able to get China and France to co-chair the Official Creditor Committee, and that helped in ensuring the financial assurances were gone. We should be now looking at the MOU and then terms of bilateral debt treatment that would occur. It might be a flow activity in which we extend the terms of the loans and give us space for that. Then we'll continue to engage private creditors to seek relief on external debt. This, of course, has to do with our Eurobond holders. So that's where we are at. We started in July of last year, in which we went to the fund. By December of last year, we had reached a staff-level agreement, which was really in record time, and then started the discussions with the G20 for the DSSI, and we finally got assurances to the fund May 12th, and then on May 17th, the fund was able to approve our program. So in all, within a space of 10 months, Ghana was able to achieve that. And as we all know, when you enter the common framework environment, you just don't know where to end. We know our sister brother countries, Zambia, Chad, Ethiopia, 2 years on are still lingering. And we hope that what we've been able to do will set a new precedent so that things will be faster and more effective for other countries coming forward. So with regards to the Eurobond investors, we have given them all of the material that they require, and we hope that in the same spirit with which we worked with the fund, worked with the Official Creditor Committee, we would also work with them to make sure that there's mutuality of interest in what we come up with, and we work our way towards coming back to market. But going forward really is how do we focus on manufacturing exports, how do we strengthen delivery of private partnerships, how do we improve the business environment, promote entrepreneurship, and really transition into a digital economy. I'm very clear in my mind that without digitalizing our economies in Africa, it's going to be very difficult to get to where we want to get to. Got into Korea, and they are not even looking at 5G. They are playing around with 6G. And that is the exciting thing about empowering local companies to be where the future is. So technology is going to be key. and therefore the centrality of MTN in this whole issue of the development of Africa. Mr. Grant is here, but these are areas of opportunity: agro-processing, manufacturing, tourism, infrastructure, and technology, of course. And I guess in my mind, this is where the board of MTN needs to really sit and discuss their role in the whole issue of African Renaissance. Is it really just the purview of only governments to structure that, or what is the responsibility of huge companies such as MTN to be engaged in actually supporting, promoting policy discussions in this area? I think that's a big question for you. And even as you look at your 2025 program, you may have to tweak it because things are different. The importance of change is upon us, and we need to find ways to ensure that social unrest is minimized. So really, I mean, ladies and gentlemen, I think we have done what most people thought would not be possible, but I think the resilience of the Ghanaian has come through again. It is one of those countries that I believe can be the key demonstration effect of a successful African country, and therefore we need to put all of our energies in there. Ingenuity to be encouraged, innovation to be supported, value in public service, ensuring that prosperity is shared, and more importantly, the private sector becomes really key to the growth agenda that we have. So for us, we are looking at launching this Ghana Mutual Prosperity Dialogue to ensure that the private sector is at the center of what we intend to do. We are confident that we will be able to get there, but we want to get there with the private sector into with us. We look at issues of our Gini coefficient and human index, and I think it's quite criminal given the resources we have as a continent. How do we leverage off of that? How do we, as citizens or the middle class, so privileged, really take that as issues of heart? In a real sense, quoting Martin Luther King, all men are caught in an inescapable network of mutuality. We are tied in a single government of destiny. Whatever affects one directly affects all indirectly. It can never be what I ought to be until you are what you ought to be. And you can never be what you ought to be until I am what I ought to be. This is the interrelated structure of our reality. And I think it is that. And from your own Mandela, a part of being optimistic is keeping one's head pointed towards the sun and one's feet moving forward. We in Ghana will continue to do that. We're looking forward to partners, especially with digital companies for innovation, and I know that we'll be able to get there. So thank you very much for this.
Thank you, Honorable Minister. If you don't mind grabbing maybe the one close to the middle there. Yeah. As the center of attraction for my camera. I'd like to also call the following guests to join us on stage. Let me start with Mr. Reginald Iyofi Grant. He's the CEO of the Ghana Investment Promotion Center. He's been referenced quite a lot in the Honorable Minister's presentation, so he has a lot to answer for. Mr. Grant, welcome. Yeah. Following him is Mr. Solomon Asamoah. He's the CEO of the Ghana Infrastructure Investment Fund. He's also been referenced a lot in terms of the strategy. Mr. Asamoah, thank you for joining us. Yeah, you just want to fix yes, thank you. And also to field any questions around, of course, the MTN business over there is the Senior Vice President for Markets at MTN Group, Mr. Ebenezer Asante. Thank you very much, gentlemen, for joining us. Let me give you a bit more detail of Mr. Grant's profile. He's a financial policy advisor in both his country and beyond. Strong record of leading advisory mandates for equity and debt transactions. More than 3 decades of experience in investment banking and finance. Thank you so much for joining us, sir. And Mr. Asamoah, he's led over $4 billion in transactions across Africa in his 25 years of working at some of the most foremost financial institutions, including the AFDB, the Africa Finance Corporation, our own DBSA, and also the IFC as well as the World Bank. In his current role, he oversees origination, structuring, and investment into infrastructure projects across Ghana. Very big job. Thank you very much for joining us, Mr. Asamoah. And of course, our very own Ebenezer Asante is the Senior VP for Markets, which includes, of course, the business in Ghana. Gentlemen, I have questions of my own, but there's also questions from the floor. I'm sure that there's lots coming from the floor, and there's already got lined up we already have a couple of questions lined up from the webcast. Honorable Minister, let me start with you. Just to reference 2 items that you touched on in your presentation, I'm keen to hear what your views are on the potential impact, first of all, of the domestic debt exchange on banks. It's a very big topic, as well as the measures that you are taking to rein in the inflation that you touched on already in the beginning. You referenced us as kind and not mentioning the numbers, then you proceeded to mention the numbers. But please help me understand to what extent or what measures are in place to rein that in.
Thank you very much indeed, and thank you once again for this opportunity. The domestic debt exchange was really a very difficult exercise because we are basically changing people's expectations of what they were going to get, and they plan their lives. And it also affected the banks deeply, so that the impairments were very high, which then led to really our analysis of believing that we may need up to about $1.5 billion for solvency and liquidity. The central bank is stepping in with the solvency of the liquidity in terms of changing adequacy ratios, etc., to really give forbearance to the banks. And we are putting together the fund, Financial Stability Fund, to be able to then intervene and give the appropriate resources to the banks to make sure that they operate in this difficult environment. So I think that's the intervention that we want. With regards to inflation, the central bank has been very clear on the way in which they are managing it. MPCs, I think maybe you had a 50 basis point. I think the past year, they might have done about 2,500 basis points of increases. But the last MPC, they actually did not do anything, which was a respite for all of us. But inflation is gradually coming down. I think the past 2 months or 3 months, it's been inching down progressively. We are now 41. The target is to be at 29 by year end, and then manage the process towards the 8 plus or minus 2.
Right. Mr. Grant, let me come to you and talk a little bit about investment attraction. I mean, there's a lot of reforms that have already been presented, but what, in your opinion, becomes the single best thing that the government of Ghana can do just to restore confidence in the economy and in so doing, hopefully encourage some investment?
Well, there are a lot of things, first of all. You said the single most. I'm not sure there should be an answer for the single most. It's a combination of a number of things, and Ken has mentioned some. But I think overwhelmingly what is quite instructive of where we are right now is the partnership of the private sector. and the fact that there's a bigger story out there that we need to confront. And let me explain what I mean by that. I mean, if you look at the African continent, it's resource rich. 90% of the world's platinum, 90% of the world's cobalt, 90% of the world's lithium, chromium, 65% of the world's manganese. It's got currently a population of 1.4 billion, which is comparable to that of India, which is 1.47, and comparable to that of China at 1.45. Yet, the continent is poor. If you look at even climate change and transitions, and when you talk of food security, Africa to date holds 60% of the world's remaining arable land left. Yet the continent is poor. So it means that there is a certain structural problem that we need to address. And I think our president alluded to that by starting with saying, look, let's build a Ghana beyond aid and Africa beyond aid. Let's use our own resources and our energies to develop our continent. Because you can't have all these resources, you can't have the population size, and yet still be poor. It means that we've negotiated very poorly in the past. That can be the only problem that we have. And so in doing so, first of all, the first lever that I think can change that is the Africa Continental Free Trade Area. The fact that we can trade between ourselves will definitely create a new paradigm for African economics by adding value to all these resources in situ and not just exporting the raw materials and the resources to other parts of the world. And I mean, today, as we speak, I mean, all of you have a mobile phone. Yeah. The coltan in the mobile phone exclusively comes from Togo. But it's taken off the ground, sent to China, processed, and then put in the phone. The lithium in most of the batteries that you need for e-mobility come from DRC. But they just pick out the lithium, export it to China again, and then they add value and export the finished goods back to Africa. So we need to change that narrative seriously. And I think ushering in an Africa beyond aid that's the first thing. The second, creating an internal intra-African market so we can trade amongst ourselves. But with a tacit agreement that we need to add value to our resources in situ and not just export them. And in doing so, partnering with the private sector, because that is key. With all these resources, with all the numbers, there are only approximately about 490 companies in Africa that have a turnover of $1 billion a year, according to McKinsey. That means we are not even monetizing our own opportunities to the extent to which we can. And in that narration, I think the private sector has a particular responsibility of actually doing that.
But Mr. Grant, I mean, what you're saying isn't new. We've heard many people call for the many things you call for and quote the examples that you quote about the potential of the continent. Yet we haven't quite achieved this very elusive place of finding a way to get ourselves out of what you've just described. My question would be, what is it that we've done wrong? What is it that we can do right?
I think, I mean, we don't need to belabor the point of what we've done wrong. We all know that. It's what we should do to right it. And I think the AFCFTA, the Africa Continental Free Trade Area Agreement, is in itself a major trigger, a major motivation for Africa to trade within itself. Secondly, the fact that we are evolving a Pan-African payment systems where you can buy in cedis and pay in rand, or you can buy in kwachas and pay in naira, is a new dynamic that didn't exist, because then it means I don't have to change my money to dollars and then send those dollars in there, and then those dollars are changed there. So it solves a bit of the problem we have with our currency depreciations. But beyond that, with all these opportunities in Africa, and you can say it in different ways, whether it's in transition energies or not, the Africa continent becomes more important. Right. Critically, because 60% of our population is below the age of 35. And so if you look at the future, this is a consumer market waiting to happen. This is a labor market that is happening. Technology is accelerated on the continent. Today, Africa has close to about 125 million mobile money users. That's more than 50% of the global total. we are about 650 million cell phone users on the continent. Very significant for technology. And we are seeing quite a lot of that. In Ghana, Ghana somehow has emerged as probably a safe place to scale up. So I am seeing quite a number of players in the data center business looking at Ghana to actually set up data centers. Why? Because they recognize the import of the Africa consumer market, and it's going to be technology driven. And so that is where they want to plant the seed. Nigeria is a big market, but for them it's more difficult to do it in Nigeria. They need a small market. I compared Nigeria and Ghana to Nigeria being the oil tanker. When it goes, it has to turn around. It might take a week to turn around. Ghana is a speedboat. When it wants to turn around, it just goes small and, small but efficient. But the Nigeria market is extremely important to us. And in fact, they are biggest, next to South Africa, they are largest investor in Ghana, African investor. So you have quite all these things coalescing into a certain realization that, yes, maybe we didn't do things right in the past. We have a great opportunity to do things much better. But would you believe that by 2018, out of the 10 fastest growing economies in the world, 6 were from Africa? But those are points that we normally don't highlight. And so when somebody wants to invest in Africa, they always demand a premium, which is totally misplaced, unfair, and unrealistic, because we've allowed the myth of an Africa that cannot develop, that has problems, to lead the way.
Well, I think it's a great segue, Mr. Speedboat, to Mr. Asamoah, who can then tell us about the infrastructure side, because it's all good and well to say we're so great, we're so great. Businesses go there, they want to operate, they need an infrastructure that works. How is the landscape looking now, and I guess going forward, in terms of the priorities for you on what infrastructure needs to be developed in the country?
Thank you very much. And for those who don't know who the Ghana Infrastructure Investment Fund, essentially we are a government-owned investment vehicle with a mandate to invest and develop infrastructure assets within Ghana. We were set up by the government. They gave us initial capital of around $325 million and said, finance and invest in infrastructure. Now, $325 million is a substantial sum for a country like Ghana. We are very grateful for the funds that the government gave us. But given the scale of the problems and the deficits, it's relatively small. So the only way we could have an impact is if we leverage the private sector and we bring co-financiers and co-investors alongside with us. And we've been very busy on that. And over the last 5 years or so, I think we've been quite effective. We now have a portfolio of 13 infrastructure investments, including projects like the new airport terminal, for those who have been there, a major expansion of Ghana's second port, Takoradi Port. We've done hospitality projects. We have done mining projects. We're doing the first major toll road project in Ghana, hoping to cut sort in the next couple of months. So for every $1 that we've invested in each of these projects, we've managed to bring $10 of other people's money to finance and invest alongside us. So we know how to attract private sector financing and private sector investment. The other thing that we're really proud of is that every single investment that we have done has been with a Ghanaian sponsor. So it also raised the level of participation of Ghanaian entrepreneurs in infrastructure development in Ghana. So what are some of the lessons that we've learned? Lessons that we've learned: if you want to attract the private sector needs to see certain things. And no matter how much you may want to try and convince them that they're being unfair or unrealistic, at the end of the day, they won't write a check unless they see those things. So we have to make sure that we structure our projects in a way that will attract and give confidence to the private sector financiers. And as I said, $300 million effectively we've invested. When all of our projects are completed, that would have brought in $3 billion of investment into Ghana. So there is appetite. There is a desire to invest in Ghana. We have to make sure that the macroeconomic environment and our specific projects are structured well. But I think Ghana is a place that many investors would like to invest in. And for all of our investments so far, despite the problems that we've had in the last 3 years or so, our portfolio is looking very robust very healthy at the moment. And that goes to how it's been structured and how we make sure that the cash flows that are generated can be captured to be able to repay financiers and investors in our country.
All right, yeah. The big oil tanker is applauding the speedboat. Tomorrow, ladies and gentlemen, Mr. Ebenezer Asante, the Senior VP for Markets, and his team in all the regions will be presenting to you. But he is joining us on the panel to take any questions you might have, along with the delegation from Ghana, which will now be called the Speedboat. There is a gentleman here with a question. I think it's from Nedbank. Just keep your hand up, sir, just so they see you. There you go.
Hi, thanks, Mr. Khumalo. It's Prashendra Nadeya from Nedbank. I've got a question for the Minister of Finance. Just your thoughts on taxes in Ghana. Obviously, the mobile money tax of 1.5% last year took the market by a bit of surprise. MTN and Salome and his team had to give some subsidies or discounted fees on those transactions. I know it's been dropped to 1% now. But going forward, are you looking to generate more tax revenue from indirect taxes or more direct taxes, and your views on that? Then I've got another question, if I can sneak it in, around foreign exchange availability now that you've got some money from the IMF, and how does that play into whether MTN can pull back that scrip dividend and get some cash out? Thanks.
The man knows how to use the platform, yeah?
Where did you say he was from?
Nedbank.
Nedbank.
Are you writing that down? It doesn't look good.
No, please. Actually, I mean, very good questions. We have a tax to GDP ratio of some 13%. So clearly, there's quite, if we look at an average of 18 to 20%, we are way behind. And so the question is not really generating new taxes, but getting efficient, because you can see the gap there. But then you have this interregnum, this period in which, you know, we are all burden sharing and making sure that we get stable. But for a center-right party, clearly taxes is not where we typically would want to go. My expectation is that with technology, with improving the tax collection system through digitalization, I mean, these taxes you talk about, we do not have to get new ones to be able to do what we have to do. Foreign exchange issues, I think we've all seen what happens when you don't have adequate foreign exchange. I think with regards to being able to restructure the debt to give us a little bit more time for that to happen so that we can manage our foreign reserves a lot better. But practically, it's the issue of generating foreign exchange. And therefore, we import maybe close to $2 billion worth of food. That's criminal. Rice, about 600 million. We launched new programs of being sort of rice self-sufficient, rice, maize, soya, and tomatoes. Actually went to one of those farms. And it's just fascinating to see that in 4 months, we are harvesting rice. You know, we created some 10,000 hectares to do that. And then you wonder, 60 years, Africa, how can we not be self-sufficient in rice? So I think it's just the reality of correcting our policy orientation, taking advantage of these poly-crises, you know, to look at things a lot more differently. And I think we can pull through this in a good way. So yes, we are not going to continue to increase taxes. We are hoping to be more efficient in collection, and that will stop that. And with regards to foreign exchange, we need to reverse it. The Africa Continental Free Trade is really, you know, a huge sign of moving from the issue of political dialogue and emancipation to economic emancipation, and I think that's where we are.
Thanks for that question. Just before we take the final one from the floor, Honourable Minister, there was a question that came online. It came from Dean Tleng. He's from Stain Capital Management. And his question is around confidence once again. How confident are you that you'll be able to grow foreign reserves again? And how confident are you that you'll be able to meet IMF requirements for fiscal consolidation?
Right. Thank you very much for that question. I mean, we came into government, actually inherited an IMF program supposed to take 3 or 4 years, and within 2 years and a little, we exited that. So our capacity to do that is very clear to us. I think this is an existential crisis. We just brought things to a head, and that's where we are. So in terms of the confidence to be able to ensure that we follow through with what we've agreed with the IMF, the post-COVID program for economic growth is our program, in which then the funds, structural benchmark, etc., were around that, and we believe that we can do it because we've done it before, and the numbers 2017 to 2020 suggest the type of trajectory that we're on until these incidents that occurred. So very confident about what we have to do these 18 months. And then somebody will say, well, but you're going to have elections at the end of next year. So what does that mean? But truly, I mean, I'm very clear that to be able to win the next elections, we are going to have a macroeconomic stability. It's not my building KVIPs or, little roads or dams here and there that's going to do it. The impact of currency depreciation is just so clear. Inflation is so clear. And then given our need for the resources that we have programmed with the World Bank and with the fund, we need to follow these targets that we have set. And these are targets we set ourselves, and these are things that we have done before. So that's where I'm confident that we can do that. And once the political elite are clear there is macro stability that will win the elections, I think we'll all be pushing in the same direction.
Great stuff. Let me just double check in the room if there's any other one last compelling question, going once, going twice. I think that's about it. Ladies and gentlemen, please give a round of applause for our delegation from Ghana. Thank you so much, gentlemen. The speedboat, yes, indeed. Thank you so much, Honourable Minister. Appreciate it. Thank you, Baba.
Right.
All right. We'll see you at dinner, eh?
Yes.
All right. Great stuff. Ladies and gentlemen, that is a beautiful end to our day. Thank you very much to all of our panelists and our speakers today. It's been a very educational day and surprisingly very positive day. I kind of thought, it's going to be one of those days where you hear about all the problems. I think we're all versed in the challenges. I think today was positive because we're all exploring solutions and we're debating the best solution as opposed to kind of dwelling on the challenges. We had a great presentation from the team that covered the dynamics that are happening in South Africa, both macro and also the specific challenge around the electricity. And of course, the team from Nigeria, led by the very able Mr. Bismarck, who did a very good presentation on what was going on, and of course the discussion that Carl contributed to as the CEO of MTN Nigeria. And then, of course, the speedboat wrapped it up for us this afternoon and really set the tone for the evening that we're about to have. I'm sure there's lots for us to talk about. The good news is that we actually have many of the people, in fact, 95% of the people that spoke today joining us for dinner. So maybe there are some questions that you couldn't ask on the panel today, or maybe just didn't think it was the right or appropriate time to ask the question. Please feel free to talk to them. I'm seeing nods from the front. They're more than happy to talk to you. They made this trip to engage with you, so please do engage with them as much as you can. Let me give you some specifics about tonight. A reminder, if you did Uber here or use any e-hailing service and you need a trip to the venue for our dinner, shuttles are already waiting outside. Our start time is 6:30 for 7 p.m. Given Johannesburg traffic, My suggestions, I know you're thinking about it, don't go home first. It's not going to happen. Just drive or join the shuttle, make your way to Melrose Arch. You can have a glass of wine wherever just before we start this evening. Our venue is the venue in Summit Place, which is, the address is 39 Melrose Boulevard in Melrose Arch. So please make sure you come to the right place over there. Also sticking with tonight, we also have a couple of dignitaries joining us. Of course, the Minister the Minister for Finance and Economic Planning in Ghana, Honorable Minister Ken Ofori-Atta, and his delegation will be joining us. We also have the Minister of Public Enterprises here in South Africa, Minister Praveen Gordon. He'll also be joining us tonight, so don't be surprised if you see him. We also have the MTN Group Chairman, Mr. Mcebisi Jonas. He'll be joining us also for dinner, as well as the Group President and Group CEO, Mr. Ralph Mopita, and his executive team will all be there. So please use the opportunity to interact. Feel free to go to the tables and have conversations. It's not one of those, there's a VIP table and there's the rest of us. No, there's all of us having dinner together. So feel free to go up and have conversations about some of the things we spoke about today. Going into tomorrow is focus on the strategy. We all heard about it. We've heard Ralph talk about it a hell of a lot in almost every opportunity he gets when he talks to the media and the market. Ambition 2025, leading digital solutions for Africa's progress. That's what the focus will be tomorrow. You'll hear more from the CEO and the CFO right at the beginning and early in the day. And then you're going to get some discussions from the people that lead these businesses where you can engage in a lot more detail and granular detail on how the businesses are running. I'm going to look at my boss to see if there's anything else that I'm missing so far. I don't think there's anything else I'm missing so far. All right. So, ladies and gentlemen, it is 17:05. We will be starting at 18:30. You've got a bit of time. We will see you in Melrose Arch for dinner.